Good afternoon. Welcome everyone to the CAMED Business School online continuing professional development workshop. This workshop is intended to help you improve the usefulness of your financial reporting and the financial reporting of your clients. It is also intended to help you keep up to date on the recent IFRS amendments that are part of the IASB Disclosure Initiative. Participation in today's workshop will be awarded with a certificate of verifiable CPD credits. During the workshop, we will ask you some questions via an application called Poll Everywhere. There will be a 10-minute break in the middle of our training session. And please note that there is live Khmer language translation, which should appear in the menu of your Zoom panel. And at the end of training, at 5 p.m. Phnom Penh time and 6 p.m. Singapore time, we will ask for your feedback on how to improve our training and to recommend a topic for our next CPD event. It is my pleasure to welcome Mr. Blaise Colivas from W Consulting. W Consulting caught our attention when their professionals authored the Wiley Interpretation and Application of International Financial Reporting Standards text, and also authored the Wiley Applying IFRS for SMEs text. We also noted that Bruce McKenzie of W Consulting was appointed as an IASB board member last year. And it was also last year that we, CAMED Business School, engaged W Consulting to conduct a review of our draft IFRS for SMEs illustrative example. It is through that engagement that I had the pleasure to be introduced to our trainer today, Mr. Blaise Colivas. Blaise is a director at W Consulting, an independent financial reporting and corporate finance advisory and professional skills training firm. He is a chartered accountant and Johannesburg Stock Exchange accredited IFRS advisor. For those that are not aware, the Johannesburg Stock Exchange is the 18th largest stock exchange in the world by market capitalization, with a market capitalization of 1.13 trillion USD, which is even larger than the market capitalization of the Singapore Stock Exchange. Mr. Colivas heads W Consulting's IFRS advisory team and provides technical advisory services and training on IFRS to the firm's clients, both locally and abroad. He served 2 consecutive 3-year terms as a board member of the South African Accounting Standards Board between 2012 and 2018. During his terms in office, he chaired the technical committee of the ASB and served on the operations committee of the board. He is currently the deputy chair of the accounting practices committee of the South African Institute of Chartered Accountants. Please join me in giving a warm welcome to our trainer, Mr. Blaise Colivas. And Blaise, I'm pleased to give the floor to you.
Thank you very much for that very warm welcome. And it's indeed a pleasure to be with all of you this afternoon, albeit virtually, but nevertheless, it's wonderful to see such a good turnout in what I think is a very interesting set of issues that the IASB has been grappling with over the last couple of years. If you'll just permit me a moment to share my screen and I'll start the presentation. Just in terms of, the presentation should be visible. There we go. So during the, as Tracy mentioned, feedback. Let me just turn off the audio. My apologies. I just want to adjust my audio. There we go. Right. So as we were about to start, So thank you once again for the very warm welcome. And as Casey explained, I'm an IFRS advisor with W Consulting, and we were asked to discuss some of the developments within better communication through financial reporting initiatives that the ISB has been working with over the past couple of years. In this session, we will be discussing the general features of financial reporting under IS1, just to set the tone and kind of to understand where all of these changes or developments are coming from and what they are aimed at. And then talking about some of the key aspects that have changed in the recent past with respect to the new revised definition of materiality. More recently, the amendment to IS1 regarding the disclosure of accounting policies. That's the latest that has come out of the ISB earlier this year, in February this year. And then to finish off the seminar with some examples of better communication cases published by the ISB recently, giving examples of how one can move away from boilerplate preparation of financial what one would maybe have considered to be generic or very template-driven approaches to financial reporting, and moving on to an approach to financial reporting that involves the use of judgment to determine what is important to use in the financial statements and how best to package the information to achieve that outcome. So that's our agenda for the 3 hours ahead of us. Insofar as the process is concerned, we will be conducting a couple of interactive polls. So at various intervals, I will ask you to either get out your mobile device and scan a QR code, or perhaps type in the web address into your browser, whichever you're more comfortable with, and to participate in the discussion by sharing your views, by providing your feedback in terms of the approach to financial to the issues that we're discussing. I see there's a couple of questions coming through regarding the audio. I don't know if I should pause until we sort that out, or should I continue? Okay, it seems to be working. Okay, just insofar as questions and answers are concerned, insofar as it relates to the technical content or the content of the presentation, I will pause at certain intervals and see if there are any questions that anybody would like me to respond to. Please make use of the Q&A function for that, as opposed to the chat function. I'm not going to be monitoring the chat function, but the Q&A will be, I'll address any questions that come into the Q&A at various intervals, once just before we take a break and then towards the end of the session. So if any of you do have any questions relating to the content, please make use of that functionality. So I guess without further ado, let's start with the first part. And the first part is more of a reflection in terms of the core principles of IS1 financial statements. The standard has been around for a number of years. As you can tell from the numbering of the standard, it was the very first international accounting standard that was issued way back in the 1970s when we didn't have IFRSs, but we had international accounting standards in those days. And this standard is essentially the starting point for any financial statement preparer, because it doesn't matter what type of industry you're in, it doesn't matter what types of transactions you are engaged with. This standard is the standard you turn to in terms of the core elements of preparing a set of financial statements. The idea of IS1 is to talk about some of the fundamental qualitative characteristics of financial statements, and then also to talk about the minimum contents of a complete set of financial statements. Perhaps this would be a good opportunity for us to start with the first poll, in which I'm going to ask you to tell me, or to respond to the options in the poll ahead of you, which of the following items here form part of, or rather, which form part of a complete set of financial statements according to IS1. So there's a number of options available to you. If you could scan the QR code, or perhaps if you are unable to scan, if you don't have a device that can scan, you can enter in the link pollev.com/goldenwindow397, and you can submit your responses. I see the responses are coming in fast and furious. Just pause for a moment to get a sense as to completeness or participation, and then we can discuss the responses in a bit more detail.
Hello. Trongខ្ញុំមិញខ្ញុំបើភ្លេចបើកឥឡូវខ្ញុំបើកសំឡេងលឺសូលីនលឺឥឡូវគាត់កំពុងសួរសំណួរថាតើផ្នែកខាងក្រោមនេះមួយណាដែលបង្កើតនៅអញ្ចឹងអូខេ
All right, we've had quite a good turnout in terms of responses. What's quite interesting to me is the makeup of the responses and how, or rather the disposition of the responses. For those that perhaps haven't noticed, but you can respond more than once, so you can select more than one option here. So it's not just the one that seems most correct. I'd like you to respond by selecting all of the items that you believe are part of a complete set of financial statements in terms of IAS 1. Okay, so let's go through the options over here. We see some support. Well, we see clear support for statement of financial position, aka the balance sheet. We see support for the statement of profit or loss and other comprehensive income. We see support for the statement of changes in equity, the statement of cash flows, and of course for the notes. But then scattered throughout the rest of the responses, we also see a couple of responses favoring chairman's report, director's report, the statement of compliance with laws and regulations, environmental and social sustainability report, and the report of the independent auditors. Now, with respect to the options that were available to you, all of these are possible items or components of what one might consider a financial report, or an annual report, or however it's termed. Some jurisdictions refer to an integrated report. However, those components of a financial report are not part of the financial statements. The financial statements are a part of, or a subset of, a broader financial report, and various jurisdictions, various regulators might require different things to form part of the financial report, but they do not necessarily form part of the financial statements. In terms of IAS 1, a complete set of financial statements comprises the following: the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flows, and the notes to the financial statements. Anything else, the audit report, the director's report, the chairman's report, any other type of sustainability or integrated report, is what one considers management commentary. I guess the audit report is a management commentary, but that's a separate issue. That's the assurance that is provided on that, but that's the need for assurance is not governed by IFRS. That's governed by laws and regulations in the jurisdiction in which the company operates. But from an IFRS perspective, the information that must be disclosed needs to be disclosed in one of the primary financial statements, and primary financial statements refers to the first 5 options on the slide: the statement of financial position, statement of profit, loss and other comprehensive income, statement of changes in equity, statement of cash flows. Those are the primary financial statements, and then the notes contain all of the supporting information that supports the primary statements. It's interesting to note that IAS 1 does not actually specify that one primary statement is superior to or more important than another. There's no hierarchy of importance. And technically speaking, all of the primary statements are equally important. They provide different information to the users of the financial statements, and therefore they have to be included in the financial statements. The notes are where we look to all of the supporting information, as I said, so all of the reconciliations or the detailed analyses or the disclosures of the judgments and the accounting policies. And we'll talk about all of those elements as we discuss some of the issues during the course of the seminar. In addition to that, IAS 1 also explains that a complete set of financial statements requires certain comparative information to be provided, and the standard distinguishes between minimum comparative information and additional comparative information. Minimum comparative information means at least the prior year's worth of financial information. So at a minimum, each company must present 2 balance sheets, 2 statements of profit or loss and other comprehensive income, 2 statements of cash flows, 2 statements of changes in equity, and 2 sets of note disclosures for all amounts that are disclosed in the notes, unless a particular standard specifically says you don't need to provide comparative information for a particular disclosure. And there are instances scattered throughout the various standards where that might be the case. The additional comparative information relates to, well, in some cases, there may be a need for an additional balance sheet comparative to be provided. In the event that there's been a prior year adjustment that affects the comparative period from the perspective of the balance sheet, then there's a need to present an additional comparative balance sheet. So in the event that there was a prior year change in accounting policy or a retrospective restatement for whatever reason, or a reclassification, perhaps because of a correction of an error, then the standard says, if to the extent that that change to the prior comparatives materially impacted the balance sheet, then an additional comparative is required at the beginning of the previous period. So just to simplify that, if we've got a financial reporting year end, let's say at the end of December 2020, and a prior year adjustment was made in the 2019 financial statements that materially affected the comparative balance sheet, and then the standard requires the company to present a balance sheet at the beginning of 2019, at the end of 2019, and at the end of 2020. That doesn't mean that a company cannot present additional comparative information to the extent that it believes it may provide useful information to the users. So the additional comparative information is a voluntary disclosure, and the standard allows you to present additional comparative information provided that that information complies with or conforms with IFRS. In other words, you can't provide non-IFRS comparative disclosures, particularly for companies that might have recently transitioned to IFRS. This is quite an important point. Otherwise, the financial statements would not be fairly presented in accordance with IFRS standards. If you choose to, or if a company chooses to present additional comparative information, it does not need to be a complete set of financial statements with respect to that additional comparative information. However, all related note information must be presented. So for example, if a company elects to provide additional comparatives for its statement of profit or loss and other comprehensive income, it can show 5 years worth of statement of profit or loss information, but does not need to provide 5 years worth of statement of financial position information as well. However, any related disclosure relating to the statement of profit or loss and other comprehensive income must extend to the additional periods provided. So it doesn't often happen, but sometimes a company might elect to provide additional comparative information where it wants to, for example, show a 5-year trend on profit trend to the users of the financial statements. And under those circumstances, these principles allow for additional information to be provided there. So when we talk about a complete set of financial statements, as you can see, anything that is not part of these of a complete set of financial statements, which I referred to earlier as management commentary, falls outside of the scope of IFRS standards. And the disclosure requirements of IFRS standards don't apply to those additional pieces of information. Fortunately for us, the IASB has provided some guidance, some useful guidance that preparers might wish to refer to in the form of a management commentary practice statement that provides useful guidance incorporating some of the core principles from the IFRS standards around relevance, materiality, neutrality, well, I mentioned relevance as well. The management commentary practice statement borrows from some of the principles related to disclosures under IFRS standards, but it does not have any authority over that information. It's provided by the IASB as a source of guidance for companies that are preparing management commentary and may wish to refer to that to assist them in the preparation of that information. The standards only apply then to the components that I've been discussing up to this point. And to the extent that a standard requires a particular piece of information to be disclosed in the financial statements, it means it must either be presented in the primary statements or in the notes. One cannot provide a piece of disclosure or achieve a disclosure requirement by including it in something that does not form part of the financial statements as defined under IS 1, unless a standard allows that to be the case. There are some examples, for example, around risk disclosures for financial instruments. Certain risk disclosures can be cross-referenced outside of the financial statements in a broader annual report, provided that the standard allows for that, and provided then, of course, that there's appropriate cross-referencing of that. But generally speaking, barring those few exceptions that I've just mentioned, anytime a standard requires something to be disclosed, it means it has to be either on the face of one of the primary statements or in the notes to the financial statements. So IS 1 applies to all companies that present or prepare general purpose financial statements, subject to, of course, a jurisdiction that requires the application of IFRS. But if you are in an IFRS jurisdiction and you are preparing general purpose financial statements, then IS 1 applies to those financial statements together with all of the other standards that apply given the company's the transactions, events, and conditions that have occurred during that financial reporting period. The term general purpose is quite important, and this is something that I'd like to just pause on for a moment and elaborate on, because it's quite an important concept when one considers the work that the IASB has been doing around this Better Communication project. We need to remind ourselves what it means when we're talking about general purpose financial statements. General purpose financial statements are financial statements intended to meet the needs of users who are not in a position to require an entity to prepare reports or information tailored to their particular information needs. So general purpose financial statements are distinguished from the management accounts of a company, or a particular annual return or submission that a company must provide to a regulator. Because, for example, a tax return that a company must submit to the tax authorities is not general purpose information. The tax authority has the ability to dictate or specify what information must be provided. And on the basis of that, the tax return is not a general purpose piece of a general purpose document. However, an investor, in the case of a listed company, an investor would look to the financial statements published by the company in order to understand how the company has performed for the year, what the financial position of the company is for the year, having a look at the cash flows. And so a minority investor is not in a position to specify or to say to the company, I need a particular report, please provide it to me, and must rely on the general purpose information for any decision making related to that company. So to the extent that a user has the ability to request or demand special tailored information for its particular information needs, that information is not considered to be general purpose. General purpose is for those users who need to use the financial statements for whatever purpose and are not in a position to ask for specific information. And we'll come back to that concept again in a short while when we get to the new definition of materiality, because as I say, that's quite an important concept when one tries to unpack this concept of when is something material. Some additional considerations regarding a set of financial statements. There's a presumption that compliance with all IFRSs will result in fair presentation. An IFRS reporter must make an explicit statement of compliance, and one cannot rectify adoption of inappropriate accounting policies by additional disclosure or explanation. I've seen some instances where companies have said, we report in terms of IFRS, except that we didn't like straight lining operating lease income, and so we did something else instead. They talk about where they may have deviated from a particular requirement of IFRS for whatever purpose. And you can't do that. The only time one can ever deviate from IFRS is if one believes that the deviation is in order to achieve fair presentation. And that's a very, very rare situation. In fact, I have yet to see that applied successfully in practice, because if one wants to apply a so-called fair presentation override, it requires a company to demonstrate why that company's circumstances are so unique to all of the other IFRS reporters around the world, who it's basically to say then that we cannot achieve fair presentation by applying IFRS, yet everybody else that applies that requirement is satisfied that they can achieve fair presentation. So you can't use disagreement with a principle of IFRS or the fact that you don't like the answer the requirement gives you in terms of how it makes you look as a basis to apply a fair presentation override. And of course, that's what the auditors have to satisfy themselves to, is that the financial statements fairly present the financial information of the company. Just some additional principles. Of course, we know that we apply in the accrual concept. The only place where accrual is not applied is in the statement of cash flows. And offsetting as a general principle, offsetting of assets and liabilities is only permitted where a standard specifically requires or permits offsetting. So generally speaking, we need to keep the assets and liabilities separate, and I'm sure we're all familiar with and the income and expenses for that matter. Another point that I'd like to talk about, perhaps on a more qualitative perspective, and that links up to some of the discussions we'll have in a short while around judgments and those types of disclosures, is around the concept of going concern. And I guess this is something that has become quite topical of late, particularly in light of the COVID-19 pandemic. Granted, some parts of the world have been less significantly affected than others, and some have managed to weather the storm a lot better than others. But there are places around the world, there are companies that have been struggling as a result of COVID-19, certainly in the travel sector, but even in other parts of, particularly in those parts of the world where there's lockdowns that affect industry and economic activity. Going concern means that a company, or saying that a company is a going concern, means that the company can continue to operate for the foreseeable future with neither the need nor the intention to liquidate the entity or to cease trading, or having no realistic alternative but to do so. So the general rule of thumb is that one assumes that the financial statements have been prepared on a going concern basis. If a company believes that it is not a going concern, if it is unable to continue to operate, and during an economic crisis arising out of a global pandemic, for example, that does mean that some companies may find it more challenging to continue to operate until the economic situation improves. So when a company does not believe it is a going concern, it needs to disclose that fact together with the basis upon which it prepared the financial statements. In addition to that, management must make an assessment of an entity's ability to continue as a going concern, and that needs to consider all possible scenarios for at least 12 months from the end of the reporting period, but not limited to 12 months. And that's quite an important point to note, is that if you believe you can make it through the next 12 months, but there's doubt that you'll be able to continue beyond that point, you're not a going concern. However, if you can't see anything within the next 12 months that would mean that you aren't able to continue to operate as a going concern, and there's nothing beyond that point that you're aware of, then one can management can conclude that the company is a going concern and therefore continue to apply the going concern basis in the preparation of the financial statements. When management is aware of material uncertainties related to events or conditions that may cast significant doubt on the company's ability to continue as a going concern, then the disclosure of those uncertainties needs to be provided in the financial statements. And I'd like to turn to the first example of disclosure. I realize the text may be a little bit small, but if you can make out the text, and perhaps those that are following along in the handouts will be able to follow along in that handout. The disclosure that you see on the screen in front of you is addressing the judgments that management has applied, management being the board of directors in this instance, the judgment that management has applied in concluding that it has the ability to continue as a going concern. It highlights the specific issues that the company is facing, the challenges. It highlights the fact that there are losses that have been made for the interim period. It talks about the net current liability position. It talks about solvency and liquidity position. It talks about the mitigating factors that the company has considered that justify the continued application of the ability to continue to operate as a going concern. And this is very entity-specific disclosure. And I guess this is part of the theme of what we're trying to discuss, or what we are discussing in the seminar, is the fact that the financial statements should tell a story of that company. One should not copy and paste disclosures from other companies' disclosures or from templates that we use to prepare the financial statements. In providing the information, in satisfying the disclosure requirements of the company, we need to reflect on our circumstances. We need to reflect on our judgments, management's judgments for our circumstances in achieving the disclosure requirements. So this is one of those areas where I think entity-specific disclosures are crucial, particularly in light of the current global economic situation. But as I say, some companies may find that the determination that they are a going concern is relatively straightforward. They haven't seen any significant challenges in light of COVID-19. And as a result of that, they believe that, I mean, they're healthy, they're solvent, they're liquid. And it could just be a case of, well, we're a going concern the same way we've been for the past 20, 30 years, or however long the company's been operating. But this is where we need to understand that there's a disclosure requirement, and in addressing the disclosure requirement, one needs to provide entity-specific disclosure. And this is something we're going to revisit a couple of times, as I say, as we progress through the rest of the discussion today. Another important issue that IAS1 addresses is the topic of materiality. Now, from the introduction, and I would imagine that some of my audience are either auditors, and some of you might be victims of auditors. In other words, the companies that the auditors audit. And this concept of materiality is something that is thrown around all over the place. We often hear the words, something is material or something isn't material. Certainly auditors and eat and live by materiality. That's the only thing that makes the auditing process manageable. And then certainly from the preparer's the preparer's perspective, the preparers of financial statements also need to understand this concept of materiality. So let me pause for a moment and ask a question of you. Is the term material synonymous with significant? True or false? The term material is synonymous with significant. True or false? Just a reminder, if you want to participate in the poll, you would have to do so by either scanning the QR code or entering the link pollev.com/goldenwindow397. seen a lot of discussion in the chat about it, but let's see how that plays out in terms of the final numbers. Give a couple more minutes, a minute or two, just to let everybody get a chance to participate, and then we shall discuss the answer together. All right, it doesn't seem like the numbers are changing much. It seems like there's clear support, as the majority seem to believe that the terms significant and material are synonyms of each other. They mean the same thing. And the minority seem to believe that the answer is false. I'll come back to this response in just a moment, but then let me ask a second question, again using the poll, and then we can come back and debrief this together. So I made the comment earlier around materiality and how important it is to the auditors. And so I'm going to ask the question slightly differently and say, do you agree with the statement that materiality is determined by the auditor and management must apply the auditor's materiality threshold in the preparation of the financial statements? The code is the same. I see questions come in around the code. The QR code is exactly the same. So if you had the page open, the question will have just changed, and you can respond to the second question again. Right, so there we have our responses. Now let's just analyze and discuss these responses and maybe just understand where we're getting the differences. Obviously, these are views that you have expressed, and I'm not saying that there's an incorrect answer, but I can certainly tell you what my thoughts are around the answers. Firstly, with respect to the first question, let's just jump back to that for a moment, where we had said material is synonymous with significant. The responses that came in here, let's just lock that so we don't get more responses coming in. The responses that we got here indicated that many of you saw the terms as meaning the same thing. And this is quite an important aspect because it actually addresses one of the recent developments that's been made by way of an amendment to the standards regarding the disclosure of accounting policies. The standards use both terms. The standards use material in some instances, and they use the term significant in other instances. And the view is that they do not mean the same thing, at least insofar as their usage is concerned in the IFRS standards. We have the concept of materiality is a defined term, whereas significant is not defined within the IFRS standards, which means that one cannot just assume that they mean one and the same thing, although I do believe that certain things that are significant are not necessarily material, but certainly anything that is material would also be significant. So from that perspective, that was kind of how you saw it, where if you responded true on this question, not everything that is significant is material, but certainly everything that is material would also be significant. And we'll come to the definition of materiality or material in just a moment. Significant, as I say, is not defined in the standards. My interpretation of it, and certainly some discussions I've had in various technical forums, is that one could look to an English language definition of significant, and this may also be a different approach that's used in different parts of the world where different languages are used. But my understanding of significant is worthy of note, whereas material, which we'll discuss in just a moment, goes a little bit beyond that. So something may be worthy of note, but doesn't necessarily mean that it's material, whereas material has very real repercussions in terms of the impact it can have on a user's decision making, and we'll come back to that in just a moment. Going to the second question that I asked earlier, with regard to who sets materiality and who should then use that number. When I said that both auditors and preparers work on the basis of things that are material, that's absolutely correct. We have a definition of material in the auditing standards, which happens to be the same or very similar to the definition of material in the accounting standards. But the auditor's view is, or the auditor's need for materiality, or the concept of materiality, is both as a tool for auditing, the actual audit process, whereby audit procedures are really designed around material balances, transactions, and so on. And of course, the auditor forming a view of whether or not there are any material misstatements that would render the financial statements to not fairly present the financial position, financial performance, and cash flows of the company. The idea behind that is that the auditor is assessing from his or her own perspective what is likely to result in fair presentation not being achieved. From the preparer's perspective, the same concept applies, but there's nothing in the standards that says that we must use the auditor's materiality number. So the concept of material is a judgment area, and that judgment needs to be applied both by the auditor and by management. There may be differences of opinion, and there may be conflicts where in some instances where the auditor believes that something is material, the preparers, the company believes it's not. And that needs to be discussed and debated and try to find some common ground over there. But from the preparer's perspective, the preparer's concept or assessment of materiality is framed in the context of IS1. And IS8 for that matter, and we'll come to that in just a moment. The idea of materiality judgments is that they are pervasive across the preparation of financial statements. An entity is required to make materiality judgments on recognition and measurement issues. In other words, whether or not to recognize a transaction event or condition, how to recognize and account for that transaction event or condition, or how to measure that transaction event or condition. So it comes around in terms of the application of the standards, and it comes about in the context of the preparation of the disclosures regarding presentation and disclosure requirements. So I'm just trying to get my mouse across over there so I can get my pointer up. So we look to materiality both from the general ledger perspective as well as from the financial statements perspective. The general ledger perspective is around the recording and measurement of the transactions, whereas the presentation and disclosure requirements is around the actual communication of the information in the financial statements themselves. And historically, materiality was discussed both in IAS8, the standard on accounting policies, which we'll come to in just a moment, and in IAS1, the standard on presentation of financial statements, from those two different perspectives. The overarching consideration of materiality in IAS1 is that it's used throughout different places. For example, IAS1 says an entity shall present separately each material class of similar items, and present separately items of dissimilar nature or function unless they are immaterial. So we're talking about materiality, but at the same time, we can also talk about immateriality when one looks at some of the requirements of the standards. We also have a requirement to aggregate. For example, if a line item is not individually material, IAS1 says it is aggregated with other items. And then in another part of IS1, it says some IFRSs specify information that is required to be included in the financial statements, but an entity need not provide a specific disclosure if the information resulting from that disclosure is not material. So as you can see, materiality is a very, very important part of IS1 in particular. There are also other areas where again, it says when items of income or expense are material, an entity shall disclose their nature and amount separately. So just through a selection of extracts from one standard alone, we see how important this concept of materiality is. But that extends across into the other standards as well. And the whole idea around materiality is around emphasizing that this is a judgmental area. Management is required to apply the judgment. The auditors are applying the judgment from their perspective, and it's about trying to find some common ground, some reasonable similarities between the two assessments so that we can advance the discussion forward. Management prepares the financial statements covering all material items. The auditors come and audit those financial statements, applying the concepts of materiality. So if we can find common ground, that would be great. But now the question is, how do we find common ground? On this call, I see there's 300 and something participants. What I might consider to be material might differ from, across all 380 people on this call. And it's not to say now that IS1 is in a position, or this IFRS standards are in a position to say, this shall always be material and this shall not always be material. We don't apply a rules-based financial reporting framework. We apply a principles-based financial reporting framework. What the standards say is, if the items are material, this is how they should be dealt with. But the assessment or determination of whether or not they are material is up to us to ascertain on a case-by-case basis. And that's where the ISB has been focusing their attention in the last couple of years as part of this materiality and disclosure initiative. So the title of this seminar was Better Communication in Financial Reporting. And that is actually the theme that the board is working under for the last couple of years. Over the last, I'd say, decade or so, we've seen quite a lot of changes coming through new standards in the form of a new revenue standard, a new financial instrument standard, a new leases standard, a new insurance standard. And all of those major new standards that have been released over the past couple of years have been quite fundamental in terms of changing recognition and measurement, changing accounting models for certain transactions. Certainly, they've also introduced new disclosure requirements. But now that those major standards that involve changes to recognition and measurement and accounting principles have been completed, of course, not all of them have yet been adopted. We're still waiting for IFRS 17, the insurance standard, to be adopted in 2023. But the previous three that I mentioned, those have all come into effect already. Now that the dust has settled on those new standards, or it's in the process of settling, the ISB has turned its attention to improving the quality of financial statements. And this theme, this better communication in financial reporting theme, is what the board is operating on at present for many of the projects that it currently has on its work program. This theme involves lots of different components, lots of different elements, and you'll see them illustrated on the slide here. We've got initiatives or projects addressing the content of financial statements and how the information is presented and disclosed, as well as ongoing projects around the delivery of the information by way of the IFRS taxonomy for XBRL purposes. XBRL is still emerging in various parts of the world in different degrees of detail and relevance. For those that aren't familiar with the term XBRL, extensible business reporting language, it's a way of communicating financial information electronically by tagging it certain pieces of information that can then be searched by a user of those financial statements and presented and analyzed and I wanted to say manipulated. It doesn't sound good when you say manipulating financial information, but certainly in terms of reading the information and comparing certain aspects of the information across different elements of the financial statements, it just allows for a more dynamic way of receiving that information by the users. So when I'm talking about electronic communication, I'm not talking about printing the financial statements to PDF and attaching the PDF to an email and sending that off. XBRL is a way of allowing for tagging of the information, kind of like social media hashtags, and allowing for that information to be read through a specialized piece of software. And the ISB is undertaking ongoing work around aligning its disclosure requirements of the various standards, its so-called, to a specified tagging structure known as the IFRS taxonomy. So every disclosure requirement within IFRS standards has a particular hashtag or tag that one can use for XBRL purposes if one wants to apply that taxonomy for that exercise. But our attention is more focused on the content for our discussion today. The content elements of this Better Communication project involve initiatives around how we structure the primary financial statements. You'll recall earlier this in the session, I explained to you that the primary financial statements are the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of cash flows, and the statement of changes in equity. And this part of the project is looking to certain aspects of certain of those primary financial statements, and I'll talk a little bit more about those in just a moment. We also then have the disclosure initiative, another thing that I'd like to spend a little bit of time talking about in a bit more detail in just a moment. So I'll come back to those two in just a short while. And there we have that practice statement on management commentary that I mentioned earlier. Remember when I said all of those other documents which might form part of the financial report, for example, the sustainability report, the chairman's report, the director's report, all of those things that aren't part of the financial statements but part of the financial report are management commentary, and the board has published a guide, a practice statement on how one could prepare that information, borrowing on some of the concepts that underpin the disclosures of financial statements. Let's turn our attention to these two blocks over here. The disclosure initiative identified, or rather the board has identified, which then led to the disclosure initiative, a problem with disclosures. And this problem hasn't just happened in recent years, it's been evolving over a number of years. The board has three main concerns, and they are that, firstly, financial statements do not provide enough relevant information. Financial statements provide too much irrelevant information, and collectively this leads to ineffective communication to the users of the financial statements. Let's just take a step back and ask ourselves, why do we apply IFRSs? We apply IFRSs so that we can recognize and measure transactions, events, and conditions according to certain set principles, and then communicate those by disclosing them and presenting them in the financial statements to the users of those financial statements so that they can make whatever decisions they need to make in relation to their dealings with that company. That is why we are applying the standards. So it's very important then that the financial statements deal with this issue of ineffective communication by addressing the issues of irrelevant information and not enough relevant information. So the board identified these two issues as the starting point for the disclosure initiative. And the activities that they have been taking or undergoing during this project, which is ongoing, it hasn't finished yet. It may never finish, or it may get to a point where they believe that they've achieved these objectives. But one of the key things, or the two key things that they are trying to achieve here are to enable preparer judgment in the preparation of financial statements, and to improve disclosure requirements where applicable, thereby leading to improved disclosures and better communication. As I say, the project is ongoing, and it stems from various issues that the board has identified over the years. I'm sure many of the people that are listening in on the call, certainly preparers, would agree that when it comes to preparing financial statements, we typically follow, there are various templates, commercial templates that one can buy and use, or perhaps templates have been developed over the years and they just get rolled forward year after year. And we kind of work on the basis of, we throw in the current year's information into the framework of a template. We turn on certain notes, we may adjust certain input fields here and there, hit print, and there we go, we've prepared financial statements. At least that's what it seems like sometimes. and turning on certain notes and just copying and pasting certain boilerplate generic wording isn't really achieving what the board says is a problem around effective communication. Because chances are that the over-reliance on templates means that we are either providing too much irrelevant information or perhaps not providing sufficient entity-specific, non-boilerplate relevant information as part of the communication with the users of the financial statements. So a lot of the board's work that has already happened as part of the disclosure initiative and is still happening through some of the projects that are still in progress are seeking to achieve or address these issues by highlighting the fact that, well, we'll talk about some of the initiatives already, but as I said, enabling the preparer judgment by emphasizing certain elements, certain principles around disclosure, improving the disclosure requirements in certain targeted standards. We've seen in some instances where new disclosure requirements have come about, or perhaps where disclosures have become more principles-based as opposed to being more rules-based. And I'll talk about those as we proceed through this discussion. Some of the projects that are still ongoing, and perhaps this is maybe just a little bit of a heads up, a bit of an update without necessarily saying that the changes have already happened, but these are some of the changes that are on the horizon, is around the primary financial statements project. I mentioned this as one of the main points a couple of slides back. The idea here is to focus on the communication of information in the statement of profit or loss. The statement of profit or loss and other comprehensive income is one of the primary financial statements according to IS1. And over the years, I mean, I mentioned earlier that IS1 was developed almost 40 years ago. And largely, I mean, there've been some changes. For example, at some point, they changed the word balance sheet to statement of financial position. And perhaps some of you might have wondered about why do I still refer to the balance sheet and not the statement of financial position? Well, because they mean exactly the same thing. And the standard setters aren't too worried about whether you call it balance sheet or statement of financial position. It doesn't really matter if it means the same thing. If the title means the same thing and it's not confusing to the users, by all means, you can use whichever term you prefer. When it comes to what used to be known as the income statement, and look into what we now have as the statement of profit or loss and other comprehensive income, notice that that title is a lot longer than what you see on the slide in front of you, because it actually comprises two things. It's got a statement of profit or loss in it, which is what the old income statement was in years gone by. And then it has a statement of, or it has the other comprehensive income section. You can actually separate those into two distinct documents in the financial statements and show a separate statement of profit or loss, which you could then call the income statement, and a separate statement of other comprehensive income, or you could combine it all into a single document called the statement of profit or loss and other comprehensive income. Now, this project is around the top part of that, what used to be called the income statement. And in years gone by, the only thing that IS1 required to be disclosed in the statement of profit or loss, or the income statement, was total revenue for the year, total interest cost for the year, total taxation charge for the year, and a total for profit or loss for the year. Those were the only totals that needed to be disclosed according to IS1. Of course, one could always show additional line items if one felt that those line items were material, and we'll come back to that concept of materiality in just a moment. But the standard did not talk about any other subtotals, any concepts such as EBITDA, earnings before interest, tax, depreciation, and amortization, profit from operating activities, profit before finance costs, or anything like that. Those subtotals, or even gross profit, that's another one that is very commonly used and yet does not feature in terms of IFRS literature. The concept of a gross profit is not an IFRS concept, and yet it features in so many financial statements. The project, as you can see, has been running for a number of years, and it had to pause a little bit during the course of last year. One hoped that the feedback could have been on the exposure draft could have happened earlier, but because of the pandemic, the board had to extend the deliberation or the comment period on that to the end of September, and the board is currently working on its redeliberations based on the feedback. So there have been some exposure drafts, discussion papers, lots of outreach activities on how to address the issue of addressing user needs around the information in the statement of profit or loss, and trying to bring in some consistency around the use of these additional subtotals that are frequently used but are not considered to be IFRS numbers. So this project aims to respond to the investor needs by requiring certain additional defined subtotals that never existed previously, allowing for or strengthening requirements for disaggregation of information in a way that allows for better analysis for various decision-making needs, and introducing the concept of management performance measures, which are considered non-GAAP measures, non-generally accepted accounting practice measures, but nevertheless, or rather non-IFRS measures. I think that's maybe more accurate, even though the board itself refers to these as non-GAAP. What they mean is subtotals or performance measures that are not defined by IFRS, but which management believes are important in assessing the performance of that company for the period under review. So these are some of the proposals that were in the exposure draft, and the proposals, if accepted, would give rise to an income statement that looks something like this, where you would have probably start with revenue as the top line, have your analysis of expenditure. This seems to be by nature as opposed to by function. We then have a subtotal, a required subtotal for operating profit. That was never a requirement before. A subtotal for operating profit and income and expenses from integral associates and joint ventures, and a subtotal for profit before financing and income tax. We would still then have the other requirements for profit, income tax expense and profit for the year. But the effect of introducing these subtotals is that our income statement will start to be grouped by operating activities, income and expenses from operating activities, income and expenses from investing activities, and income and expenses from financing activities. And those of you that are familiar, this would obviously seem familiar to you with the statement of cash flows, where that primary statement is also analyzed by those three main categories of cash flows. So I do think that these proposals are quite intriguing. It remains to be seen how the board will respond to the feedback that it's received from the exposure draft that the comment period ended at the end of September last year. In the event that this is agreed to by the board, the exposure draft will give rise then to a new IFRS, which will presumably at some point replace then IS1 once it is published. So this might become IFRS 18 at some point. And then there will be some consequential amendments made to the other standards, IS1 on the statement of cash flows, and then certain of the other standards that are affected as a result of these proposals. But largely the other requirements of IS1 will be carried forward with limited wording changes. So things like materiality and the disclosure requirements of the balance sheet and all of the other aspects that aren't related to the statement of profit or loss, those will continue. But the changes made around the statement of profit or loss are significant enough to warrant a sunset on IS1 and replacing that with a new IFRS standard going forward. The next project that's currently underway is around a targeted standards level review of disclosures. This is also part of the ongoing disclosure initiative, where the board is now considering looking at certain standards that are notorious for being quite onerous when it comes to disclosure requirements. IS 19 on employee benefits, in particular, the disclosure requirements for defined benefit plans, where one could end up with a literal shopping list of disclosure requirements when one has a defined benefit plan. Very often those are just copied and pasted from the valuer's report or the actuary's report. And the question is there a better way of perhaps providing useful information around those disclosures relating to those types of employee benefits? Another standard that also is notorious for being quite onerous when it comes to disclosure requirements, or the volume of disclosure requirements, is IFRS 13 on fair value measurement. So the board is looking at these two standards as a starting point to say, can we have a relook at this and perhaps give these disclosure requirements more as examples of disclosures that may be useful, but allowing the users more judgment, more room for judgment around whether or not to include certain of the information. And I think that will require the board to reach out to users of financial statements. In other words, looking to all stakeholders, not just to preparers, to say, right, you're reading these financial statements. Do you need to know all of this information around a defined benefit plan? It may be relevant in terms of the measurement, but are you getting any valuable information coming out of that? If not, then maybe only require the disclosure if management feels that it's essential to explain a significant change in the current year, as opposed to just having to repeat it year after year. So I don't know how this project will play out because we have not yet seen these disclosure or the exposure draft on this project. But in terms of the board's objectives, the board is trying to find a more practical way of dealing with the disclosures without cluttering the financial statements with pages and pages and pages of irrelevant information. One last project that's in progress then before we move back to the projects that have been completed and that we now need to apply is the subsidiaries that are SMEs project. Now, given that in your jurisdictions you have both an IFRS and an IFRS for SMEs category of reporter, the question is what happens when a company is itself an SME? In other words, it qualifies to use IFRS for SMEs, but it is a subsidiary of an IFRS reporter who has to apply IFRS, and therefore, because IFRS says when you consolidate your subsidiaries, you have to consolidate using consistent accounting policies. Very often what happens there is that the parent says to the subsidiary, I understand that you can use IFRS for SMEs, but I need IFRS information, and therefore you're going to have to apply full IFRS in your financial statements. It creates a very unfortunate situation where a company is obliged then to follow all of the more complex and onerous disclosure requirements of full IFRS, when really it should have qualified for simplified reporting according to the IFRS for SMEs disclosure requirements. So this project aims to try and provide relief. Obviously, this will be jurisdiction dependent, and the laws, the corporate laws would have to permit this in the various jurisdictions. But from an IFRS perspective, what the board is investigating is the possibility of allowing such companies, such subsidiaries who are SMEs, in other words, they have no public accountability, to apply the recognition and measurement requirements of IFRS standards, and therefore be able to give those trial balances and lead schedules to their parents for consolidation purposes, but provide the disclosures of IFRS for SMEs in their own financial reporting, in their own financial statements. So it will be a hybrid type model, which means that you're applying full IFRS accounting, but IFRS for SME disclosure, should you qualify for this. The board is looking at jurisdictions that would permit this, and they are currently discussing this in their meeting agendas for the current year. And it remains to be seen how this plays out. There are jurisdictions that already have something similar in local GAAP. For example, in the UK, that springs to mind that is allowed under UK GAAP, where you apply the full IFRS accounting debits and credits, but provide SME disclosures. So this will provide some relief, hopefully, going forward. Let's turn our attention to some of the disclosure initiative projects that have been completed to date. And that's where I'd like to draw our attention to some concepts around materiality and disclosure of accounting policies. So with respect to the projects that you see on the slide in front of you, we'll talk about all of these over the remainder, well, with the exception of the last one. So let me maybe talk about that last one, get that out of the way, because that's a very specific narrow scope amendment to a standard as part of this whole exercise of better communication, as part of the disclosure initiative. The board felt that there was a need for additional disclosure of cash flows relating to, well, a reconciliation of movements in liabilities, including non-cash flows relating to financing activities. So just very briefly, what that's all about is when you prepare your statement of cash flows, that only includes cash inflows and outflows. However, your liabilities, your long-term non-current liabilities may involve non-cash movements that have occurred during the year. For example, a lease is a non-current liability, a lease liability, and the cash flow statement will present the cash payments against the lease, but it would not reflect adjustments such as modifications, the recognition of the lease in the first place. Those are non-cash movements. So all they did was they amended IAS 7 a couple of years ago to require disclosure of a reconciliation of changes in the carrying amounts of the liabilities relating to financing activities. But that's very much a specific disclosure requirement. So in that instance, the board actually added a new disclosure requirement rather than necessarily decluttering or taking away. But again, this must be read in the context of the ongoing other activities around the disclosure initiative. The other projects that you see on the slide in front of you, the amendments to IAS 1 and IAS 8 around the definition of material, the materiality practice statement, the better communication case studies that we'll still look at a little bit later this afternoon, and the amendments to IAS 1 to remove barriers into the application of judgment. Those have largely centered around IAS 1, IAS 8 as well, but IAS 1 in particular. And they have come about over a number of years. We've seen, going back to September 2017, we had the issuance of a practice statement on how one could make materiality judgments. And the board said when they issued that, they didn't want to create a mandatory guide on how to, or they didn't want to create authoritative requirements for materiality, because they are not in a position to say, this is material and this is not. It's open to judgment. But having said that the concept of materiality requires judgment, this practice statement assists preparers and auditors to consider the application of these principles in practice. So it comprises some examples, some case studies. It talks about the concept of materiality from various perspectives, from the recognition and measurement, from the presentation and disclosure, and also provides a framework for assessing when a particular disclosure may or may not be material, which we'll talk about in just a moment. The board amended the definition of materiality, which we'll talk about now. And most recently, the board amended IAS 1 and the practice statement regarding what types of accounting policies need to be disclosed. So these initiatives or these actions all came about because the board realized that there's uncertainty around the concept of materiality and certainly how it works in a practical context, and the fact that the IFRS disclosure requirements are used like a checklist. Now, I'm going to pose a question here. There's no poll, so don't worry about that. But you can answer yourself and nod to yourself or shake your head, but just think to how the financial statements are prepared generally. We probably have some kind of checklist, whether we get one from the firms, the large firms that are published freely, or whether the auditors provide us with one. The auditors might develop their own checklists, depending on what methodologies they use. And generally it will say, right, so for property, plants and equipment, these are the disclosure requirements out of IAS 16. For share-based payments, these are the disclosure requirements from IFRS 2. And one works then through that, and generally it's done, I mean, for example, from the auditor's side, it's usually done by the most junior trainee that gets it, the new trainee on the job. They're given the draft, they're given the financial statements, they said, right, just check these financial statements against the checklist, and if anything's missing, go back to the client and get them to put something into the financial statements so we can sign off. Does that sound familiar? That is not what the board wanted when they set up the disclosure requirements in the standards. So this is where we now this is where these amendments become relevant to us. Let's turn our attention firstly to the definition of material, because although it came a little bit later, it's important for us to understand this in order to understand what the board is trying to achieve here. The old definition of material says omissions or misstatements of items are material if they could individually or collectively influence the economic decisions that users make on the basis of financial statements. Materiality depends on the size and nature of the omissions or misstatements judged in the surrounding circumstances. The size or nature of the item or a combination of both could be the determining factor. Now, to anybody that's been listening on this webinar for the past almost an hour and 15 minutes, I'm sure by now, if you've been listening, then you must have learned this definition on your first day of accounting school when you were a little accountant growing up to become a big accountant. And it's something that's inherent in the basis of a professional accountant. But what I'm reading from that is something is material if the users care about it. The word material means it matters. So if the user's decision-making could be affected, either because something is incorrect or was left out, then it means it's material. And this definition also talks about the fact that material could look to both a quantitative materiality and a qualitative materiality insofar as it relates to either the size or nature or both of an omission or misstatement. So this definition has been around for many, many years, and it's the same definition in the auditing standards in the ISAs. But the new definition of material reads as follows. It says information is material if omitting, misstating, or obscuring it could reasonably be expected to influence the decisions that the primary users of the general purpose financial statements make on the basis of those financial statements, which provide financial information about a specific reporting entity. Let's just unpack that, because certain of the words are the same, maybe reordered a little bit. And by the way, the fact that they don't talk about size or nature in this paragraph, it's still there, it's just in one of the subsequent paragraphs. So the concept around qualitative versus quantitative materiality still exists. But what I want to focus our attention on here is the addition of a couple of new things. We have this new concept of obscuring information. We now have reasonably be expected to influence the decisions. And we now have reference to primary users of general purpose financial statements. The old definition didn't have that. So we still consider the nature or magnitude of the information or both, but let's understand what the significance is of these new words that have been added in there, and understand then the concepts around what the board is trying to emphasize with respect to these changes. Firstly, with respect to obscuring information. The old definition didn't have that. But now, for the first time, the board has provided ammunition to preparers, to auditors. I'm not saying now that the auditors are the ones that always wanted the information to be there, but to anybody that's involved in the process of preparing and auditing financial statements, we now have ammunition to say, we must be careful that we don't obscure material information with immaterial information, because that could have the same effect on a user's decision-making as if you had left out the stuff that's important, the stuff that matters. And the standard gives us 5 examples. The amendments to the standard give us 5 examples where one might obscure material information. For example, where information regarding a material item, transaction, or other event is disclosed, but the language that's used is vague or unclear. So you could hand on your heart say, there we go, we've got information there relating to a particular transaction. But the information is vague. It talks about the financial effects were accounted for using judgment, and that's the extent of it. We don't know what the financial effects were, so it's unclear how the transaction was accounted for. Or perhaps we're using too much jargon, and that confuses the users, and it's not clear to the user, or perhaps too many acronyms or abbreviations. So any one of those outcomes could have the same effect as if that information was left out, if it's obscured, if it's not clear to the user how the information, or what the circumstances around that information were. The second example is where information regarding a material item, transaction, or other event is scattered throughout the financial statements. Now, again, many of you might recognize this from your own financial statements, where your template is set up in such a way that the balance sheet effect is shown in one note, the income statement effect of a particular transaction is shown in another note, and then the risk disclosures relating to that are somewhere else, especially when it comes to things like financial instrument disclosures. And while you might say, well, fine, all the information is there, and we can tick all the various components according to a checklist, but by scattering information across the financial statements, you may have the same effect as obscuring the important stuff relating to that particular transaction, event, or condition. Where dissimilar items are inappropriately aggregated, or where similar items are inappropriately disaggregated. Use of the term other for a line item that comprises completely unrelated items, just with this boilerplate vague description of other, isn't helpful to the users because it's obscuring potentially material information, unless, of course, what's in that other line item is completely immaterial, in which case it's acceptable. But I often see financial statements where other is the biggest item in a particular list or reconciliation. And then the question is, but are you not potentially obscuring important information for the purposes of those financial statements? And then the last one over here, I guess this is now the ammunition to say, if we are throwing in immaterial information, clutter, this is what I call the clutter, the decluttering element of this change. If we are reducing the understandability of the financial statements by including immaterial information to the extent that the primary user is unable to determine what information is material, you are then potentially obscuring material information, and that's a no-no according to IS1. So that is the whole discussion. That's the discussion around the relevance or the significance of adding in the word obscure in the definition of material. The next aspect is to consider the primary users. Let's do another poll over here. Let's see who are the primary users of a company's financial statements. It's the same link that you used previously. So again, if you could just refer to the link in the chat. Let me just turn on the QR code. Apologies. Thought it was. Who are the primary users of a company's financial statements? Please type in as many as you think. So if you've got more than one primary user, by all means include as many as you think are important. But let's get a sense as to what you believe are the primary users of the company's financial statements. Okay, quite a lot of responses coming through, but certainly from what I can make out, it seems that the most often used word here was shareholder, investor, shareholders. I'm just trying to pick out some of the others. Directors. Directors are, in my mind, aren't primary users. The directors are in a position where they can access management information. They can, and likewise where people are saying, management or accountants, I'm assuming we're talking about internal to the organization. So internal users, in my mind, are not primary users of the general purpose financial statements. Remember, the general purpose financial statements are the financial statements that are prepared for those parties who are not in a position to request tailored information or management information. So it's generally external parties, although when we say external parties, the shareholders are external to the company in the sense that they're not involved in the day-to-day management, although they may wear the same hats. You may have a shareholder who is also part of management, but I'm talking now from the perspective of shareholders who are not in such a position. Auditors are not users of financial statements. Auditors provide an opinion on the fair presentation of the financial statements. So I don't believe that they would be viewed as auditors. I'm just scanning through a couple of others over here. I see bankers, certainly, yes, providers of finance, suppliers and customers, yes, to an extent, although there again, it's a tricky one because suppliers and customers may ask for it, but I mean, if you don't want to give a customer your financial statements, you don't have to give them. I guess it depends on how important the customer or supplier is to you. And under those circumstances, then you'd probably give them the general purpose financial statements. Regulators is another one that seems to have come up a couple of times. And regulators are another interesting one because regulators, by way of their regulatory authority, can ask for whatever information they want. If they are government, if the taxman can say, I want to see a list of all of your assets that were purchased during the financial year, you're going to have to comply with that. So you know, that's not going to be in your financial statements. Certainly regulators and some of these other parties that are mentioned over here may also look at the financial statements, but if they can access specific information for their needs, they are not primary users of the financial statements. The primary users are the users who cannot get anything else, and therefore they are the ones who need to rely on the financial statements themselves. And this is an important concept when it comes to this definition of material, because we need to consider in the context of the definition, it says, if the primary users, if the information could reasonably be expected to influence the primary users of the general purpose financial statements, then we need to consider the characteristics of a primary user and our own circumstances. The characteristics of a primary user would typically mean that we are considering somebody that has at least a reasonable knowledge of business and economic activities. It's not our role as the preparers of financial statements to school them on principles around financial statements or other financial accounting and things like that. One can assume that they understand the concept of what a profit means, what an income means, what an expense means, and things like that. And so one should not need to go into that level of detail. But at the same time, they may need to understand some more complex economic phenomena when it comes to interrogating and understanding the financial statements. So the board's view on this, and this is explained in the amendment that was made to IS1, is that the primary users would typically comprise investors, lenders, and creditors. But one must consider the fact that each company's circumstances may differ. So if you are not, I mean, if you're a privately held company and there's no potential that you're going to involve external investors or anything like that, then your focus on the information needs of investors is secondary. You're not looking at them as a primary user. Whereas you may need to provide the financial statements to the bank in order to qualify for a loan or to obtain funding, or to your creditors, and therefore one would consider the information needs of those parties in assessing whether something is material or not. Also, let's understand the role that these parties play. I believe that a majority investor that has control of a company is not a primary user of those financial statements. A minority investor is probably a primary user because the majority shareholder is in a position that he or she could demand whatever information they wanted, and the management will provide that information. Otherwise, they're going to need to put their CVs on LinkedIn and start looking for another job. So a majority shareholder is not a primary user. A minority shareholder probably is a primary user. So to go back to the point, primary users of the general purpose financial statements are the users not in a position to require specific information. They need to rely on the general purpose financial statements for their decision-making needs. One can assume that the primary users have a reasonable knowledge of business and economic activities. And on the basis of that, one then says, right, so what information do these users need to understand around our transactions, events, and conditions for the year, our financial position and financial performance for the year? The old definition referred to could influence, and the new definition says reasonably be expected to influence. What this basically, the significance of this change is that one doesn't need to consider that the fact that somebody in an extremely unlikely outcome could have their decision-making influenced, that now means that the information is material. One can also factor in the reasonable likelihood that that would ever occur in assessing whether something is reasonably expected to influence a user's decision. And in making that assessment, the standard says consider the nature of the business, the public accountability aspects of the business, the industry in which the business operates, the economic environment in which it operates, and its going concern and liquidity position. And these can change year on year as business changes. As an example, 2 years ago, there wasn't that much focus on things like going concern and liquidity. And generally speaking, unless there was something extreme, one would not have expected to see much discussion around judgments around ability to continue as a going concern. But in the midst of a global economic crisis arising from a pandemic, again, depending on the jurisdiction in which we're operating in and the economic environment for that company, one would expect that that now changes some of the information needs, and users would probably want to see more discussion around going concern than they would have expected in years gone by. So applying the concept of materiality means that looking year on year, entity by entity, primary user by primary user, looking at what is reasonably expected to influence decision-making of the users, that should determine what is considered to be material from one period to the next. That definition, that revised definition, came into effect for annual periods beginning on or after 1st of January 2020, which means that for December year ends, it had to be applied in the preparation of the December 2020 financial statements. For any company that has a year end other than December, that means that in the next round of financial statements that you prepare, this revised definition of material needs to be considered for the purpose of making materiality judgments. And that takes me to the next point that I want to talk about before we take a short little comfort break. How do we then make these materiality judgments in light of this revised definition of material? And this is where we turn our attention to the materiality practice statement that I mentioned a short while ago. This materiality practice statement was developed to assist preparers of financial statements to apply their judgments on the understanding that in a discussion or in a debate with an auditor, for example, where there's different judgments, different views around whether something is material or not, as the case might be, this will hopefully guide the conversation in a helpful manner to a position where one could find some kind of common ground or agreement around the concept. It is primarily focused on presentation and disclosure issues because that was the context in which this document was prepared. It's non-authoritative, meaning that nobody can be qualified, nobody's financial statements can be qualified because they didn't follow the materiality practice statement, but understand that what the practice statement is trying to do is to explain the application of the concept of materiality in a scenario, in a practical scenario. And the focus here is to remind preparers that we're preparing financial statements for existing and potential primary users of the financial statements. And therefore, we need to consider it from all aspects. And we said earlier, it's pervasive. It affects recognition, presentation, measurement, and disclosure. But in applying the four-step process that the practice statement refers to, it says, in deciding whether something is material for the purposes of the financial statements, the four steps that they recommend we follow is, firstly, identify information that has the potential to be material. And that means that we're not throwing away the checklists. We're not throwing away the templates. The templates are useful. The checklists are useful as a starting point because they include things that in the financial, in the IFRS standards, the standard setters said this information would potentially be useful, would likely be useful if it is material. So the templates and the checklists refer to the disclosure requirements in the standards as a starting point. And there may be some additional regulatory requirements in each jurisdiction that, certain additional things that have to be disclosed. So step one is identifying information that has the potential to be material. I'm going to use an analogy, a fisherman that casts his net out wide. So that's where you go through the checklist, through the disclosure requirements and the standards and say, these things should be disclosed if they are material. Step two is the fisherman pulling the net in, where you now assess whether the information identified from step one is in fact material. And that requires you to refer back to that definition of material that we've just discussed, look into who the primary users are, looking at the circumstances in the current environment, in the current financial year, and applying your judgment and saying, this piece of information, although a standard requires disclosure of it, we don't believe is material, and therefore we're throwing it out. Just like the fisherman throws out certain of the catch that he doesn't like. Step three then says, organize the information in the financial statements in a way that communicates the information clearly and concisely to the primary users. And we're going to talk about that when we come back from the break and look at some case studies of how some companies have taken that challenge on and addressed that. And step four takes a step back and says, Let's now review the financial statements to determine whether all material information has been identified and appropriately disclosed. Maybe get an external reviewer to review it independently, ask the auditors for their view on this, but understand that this process requires, if you're still using the checklists, a disclosure checklist, you need an extra column, basically. You need to have not just a column for yes or no, but is it material? And if not, why? Or if it is material, why? You need to be able to justify both views on that. Because if the auditors come back and say, why didn't you disclose a piece of information? Management must be in a position to say, we did not disclose it because we felt it was not material for the following reasons. And if management comes back and says, but why did you disclose a piece of information? We don't see a disclosure requirement for it. You need to be in a position to say, we disclosed the information because we felt it was important for the following reasons. So whichever way your judgment around materiality of the disclosure goes, you need to be able to justify it so that you can have that discussion, so that you can find that common ground. Folks, we've reached, we've just got two more aspects that I'd like to talk about, but I think let's take a short little comfort break. We are about 20 minutes to the hour, so I think let's take a short little comfort break. We will take a 10-minute break and be back in 10 minutes time, so that will take us to 10 minutes to the hour. Welcome back, everybody. I hope you made good use of the break and you're feeling a bit refreshed since we've been dealing with quite a detailed bit of information regarding the disclosure initiative of the IASB. During the break, I used the opportunity to just read through some of the questions that had been submitted to me through the question and answer interface. And I just want to respond to some of those questions before we go back to the discussion around the disclosure initiative. So the first question came in from Arya Pratama. The better communication in the financial reporting is a very good project theoretically. However, in practice, almost all the IFRS implementations are costly. What is your assessment regarding the reporting cost after the implementation of this project? What will be needed for the entity to successfully implement this project? I think this is something that would probably, my response to this will probably make more sense when we talk about some of the better communication case studies that some companies have undertaken an exercise to do exactly that, to try and restructure their financial statements, the preparation of their financial statements, and where they've also shared some of their experiences around what's involved. And I guess when to the comment around, yes, anytime one needs to implement a change, it's costly. The question is the cost warranted? I do believe that when one goes back to the objective of financial statements, any project that aims to improve the communication to the users of the financial statements needs to be considered. When the board looks at all of these, undertakes any activity around new requirements and that, they also do a cost benefit analysis. And I do believe that while each company's circumstances may differ, it's not to say now that this would be an irrelevant or an unnecessary exercise. What is unfortunate is that many companies have taken that stance, particularly in light of other more pressing issues in recent years. So, for example, some of our clients, where we had said to them, look, at some point you need to relook at how you prepare your financial statements. And it's always been a case of, all right, but we've got other more important things to do, other areas where we need to spend money, and therefore this kind of gets put to the side. As more regulators take the lead in enforcing the application of IFRSs, as you find more jurisdictions, for example, where penalties become applicable if companies have not complied with the requirements, that's usually where one sees that, you know, companies start paying attention to the requirements, and then cost is not something that is necessarily a basis to argue why not to address it. But as to how, will it be an expensive exercise for everybody? Some of the examples I'm going to show you will indicate that not all the changes need to be costly and complicated. Some basic changes can actually just happen with a couple of quick fixes. And I think the case studies that we'll go through in just a moment will explain that. There was a follow-up question. The better communication in financial reporting focused more on the aspect of disclosure. And the question is, how about the recognition and measurement? Do you agree with me that the better financial statements should come with the improvements in all accounting aspects, not just one aspect? Well, yes, and I don't believe that the board is ignoring recognition and measurement. It's just that right now the focus is on, well, our discussion today is on disclosure. It's not to say that that's the only thing they're working on. There are other projects where they are continuously relooking at some of the implementation challenges around the major new standards, but that work generally is being done as narrow scope targeted issues, either through the work of the IFRS Interpretations Committee or as a result of the annual improvements to IFRSs, or possibly as part of the post-implementation reviews that are done on those standards after they've been in effect for a period of time. So to the extent that there's a need for a change to a standard to address recognition and measurement, that will still happen. But the project, this theme of projects that are currently being looked at is mainly focused on disclosure. And if the board is aware of a particular issue regarding recognition and measurement on something else, then they will deal with it within their processes. So I don't think that that's been ignored. Question came in, I missed at the moment, so I would like to confirm materiality is the same as significance or not. That was to my earlier question. No, technically speaking, they mean different things, although we don't have a formal defined meaning for significant. And as I explained, I think I could say that anything that is material would also be significant, but not everything that is significant is necessarily material. And so the one is an aspect of the other, but they do not necessarily mean exactly the same thing. And they are used differently in different places in the standards. So our focus here is on the term material. A question from Edmund. I noticed that IFRS 8's operating segments is not included in the list of related standards to be amended. Are the disclosure requirements in IFRS 8 not affected by this project? I suspect that the question came off the part around the targeted standards level review of the standards. And at the present moment, no, there's no, I mean, they will probably get to IFRS 8 at some point, but IFRS 8 in and of itself is not really an onerous standard, because IFRS 8 does not require disclosure of things that are not part of what management looks at in terms of the decision making. So in that respect, while IFRS 8 might say you need to disclose X, Y, and Z, if that is provided to management in the management accounts. If it's not provided to management and the cost of preparing it is considered to be undue, then you don't need to provide it. So if anything, IFRS 8 is probably one of the more lenient standards at present. But that's not the case presently with the standards that they're looking at. But does that mean they're not going to look at IFRS 8? If it becomes apparent that there's an issue around the disclosure requirements of IFRS 8, certainly they will. But it's just not part of this round of attention that's happening. And then the last question from Anonymous, could you kindly give a few more synonyms of the word materiality? I'm wary of giving synonyms because when we're talking about defined terms, that's where we've got to be careful, because as you see from the conversation we've had up to this point, the definition involves very certain words that are used with a very specific meaning. And that's what my aim here today is to explain the meaning behind the words that are used as part of the definition of material. So no, I don't have a synonym for material other than to say something is material if it matters, if the users care about it, but that's just simplifying the term. But the focus is on all of these components that I've been discussing in the explanation up to this point. I will deal with any questions that come in from this point onwards when we get to the end, but I just thought I'd deal with those that had come in earlier as we had gone, that had come in up to this point. So let's just go back to where we were before we took a short little break. I had explained to you then that the new revised definition of material becomes effective from 1st of January. Oh, no, my apologies, I've jumped to the wrong slide there. Just give me a second to get to the right slide. I explained that the revised definition of material came into effect from 1st of January 2020, and it dovetails quite nicely, quite closely with the materiality practice statement that had been issued earlier in explaining how this new concept of material can be applied in a given situation. But the key thing, and maybe just to reinforce the message over here, is that it now becomes incumbent upon the preparers to identify what disclosure requirements are material, and then on the basis of that, to determine how to include it and how to present it within the financial statements. Going back to the requirements of IAS1, IAS1 also requires the inclusion of the notes to the financial statements. And the notes to the financial statements are not defined in terms of a format. The standard simply says the notes must disclose the basis of preparation, the fact that it's the application of IFRS, the historical cost basis, and explaining where fair value is used as needed, any information required by the standards, and any other information relevant to enhancing an understanding of the financial statements that may not be required by the standards. So to the extent that there's a requirement by a regulator or for example, in your country, in your respective country, you might have a particular requirement to disclose a piece of information that is not a requirement of IFRS standards, but the law says it has to be disclosed in the financial statements. IFRS isn't saying don't disclose it. IFRS is saying disclose it to the extent that you either have to or because it enhances an understanding of the financial statements, but disclose it in light of the concepts and the philosophy of what we've been discussing up to this point. In other words, if it's something that is a compliance issue, but management feels it doesn't really add much value, or it might actually obscure material information, when it comes to structuring or ordering the information, perhaps move it somewhere to the end of the financial statements, to the very last note, where you can have a note that talks about regulatory disclosures or compliance disclosures, or whatever the case is. Don't have that front and center, unless, of course, the law requires it to be front and center, but that's where judgment needs to be applied. Avoid cluttering the important stuff with the stuff that's not important but has to be there in order to achieve a particular disclosure requirement or compliance requirement. The standards, I mean, this IS1 says cross-referencing should be used liberally. In fact, I'm adding that word in, it's not in the standard, but I believe cross-referencing is essential if it's going to help the user to navigate his or her way through the financial statements. And within the financial within the notes, the standard also says, disclose a summary of significant accounting policies covering the measurement basis used and other relevant accounting policies. Well, actually, that's what it used to say. It used to say, disclose a summary of significant accounting policies. A couple of years ago, IS1 was amended to delete the word a summary of significant accounting policies. And so that with that amendment, it read, the notes should comprise significant accounting policies and other explanatory information. And they also then at the same time clarified that each entity needs to consider the nature of its operations and the policies that the users of financial statements would expect to be disclosed for that type of entity. So that was a first attempt by the standard setters to try and avoid the tendency that had evolved where companies were throwing in pages and pages and pages of irrelevant accounting policies on the basis that of achieving that particular disclosure requirement. Let's just understand the concept of accounting policies in a little bit more detail. And for the remainder of this discussion, I'm just going to highlight a couple of key points out of IAS 8, the standard on accounting policies. The standard actually deals with changes in accounting estimates and errors, but I'm not going to get too caught up in the discussion around those. Just at a very high level, I'd like to talk about some of the concepts around how we select our accounting policies, because I think that's quite an important point when it comes to disclosing the accounting policies. When you select your accounting policies, according to IAS 8, you select your accounting policies by applying the requirements of an IFRS that relates to that transaction, event, or condition. So if I've got a transaction, event, or condition that I need to now account for, IAS 8 says, I need to select an accounting policy for it by applying the requirements of whichever standard deals with that transaction, event, or condition. If that transaction, event, or condition is not dealt with by a particular standard, then IAS 8 explains that one can also use judgment, management can use judgment to develop an accounting policy that provides relevant and useful information to the users of the financial statements. And in doing so, the standards also refers to an implementation hierarchy, which basically means that the order in which you would consider sources of guidance for developing the accounting policy is to first consider accounting requirements of other standards that deal with similar or related issues. In the event that there is no such standard that deals with similar or related issues, then one can consider the conceptual framework for financial reporting to develop an accounting policy. One can also consider industry practice or falling back on other standard setters around the world, local GAAP or GAAP, that may have been developed on something that IFRS presently does not deal with, to the extent that the industry practice or other GAAP does not contradict with or conflict with the conceptual framework for financial reporting under IFRS. So in developing the accounting policies, we have an accounting policy for everything. Whether, I mean, if you buy a pen and that is a transaction, there's an accounting policy for that. The question is, are you now going to disclose the accounting policy to account for that pen or that item of stationery? If you engage in a share-based payment, you will have an accounting policy for that as well. If you have an employee benefit plan, you will have an accounting policy for that, and so on and so forth. Now, the question is, which of these accounting policies need to be disclosed? And that's the issue that was addressed as a result of a recent amendment to IFRSs. Just before we move away from IS 8, as I said, I'm not going to talk too much around the accounting for a change in accounting policy or correction of error, because although that's relevant and important from an IS 8 perspective, it doesn't really talk to the issue we're discussing now around the disclosure of accounting policies. But there is one other aspect around IS 8 that I'd like to draw your attention to, and that is this rather odd disclosure requirement that some of you may have noticed some of you may have tried to address. IS 8 requires that a company must disclose the management's assessment of the impact of a standard that has been issued but is not yet effective. And what I mean by that is, so I made an example earlier of IFRS 17, the new insurance contract standard that's now been issued. IFRS 17 was issued back in 2017. The effective date was first 2021, and then it was pushed out to 2023. So right now, if you're an insurer and you are preparing financial statements, you are not applying IFRS 17. I don't know of any companies that have early adopted IFRS 17 just yet. The question then is, what needs to be disclosed in respect of that? And the standard gives us some guidance. It says, in the event that there is a standard that has been issued but is not yet effective, whether that's a standard or an interpretation of IFRSs, the disclosure requirements say disclose this change is set out in the standard, the fact that the standard has not yet been applied, known or reasonably estimable information relevant to assessing the possible impact on the financial statements, and state the title, the date of application, the date application is required, and the date that the entity plans to apply the IFRS initially. I mentioned IFRS 17 because that's probably the most significant new standard that is not yet effective. But there's also a whole host of other amendments over the years, narrow scope amendments, all with different effective dates, some 2020, some 2021, some 2022, and so on and so forth. My question to you is, do you need to disclose all standards that have been issued but are not yet effective, or only those standards that are applicable to the company? Your choices for the poll are: all standards issued not yet effective need to be disclosed, only the standards issued not yet effective that are expected to materially affect the company must be disclosed, or the last question, or last option, all the standards issued not yet effective that are applicable to the company must be disclosed, including those that are not expected to materially affect the company. Please select which of these three answers is the correct answer in your opinion. I haven't seen any results coming in. Is there a problem with the poll, perhaps? Just want to check. All right. From the responses that have come in so far, we have, sorry, let me just get my screen right there. So we have support for the middle answer, only the standards issued not yet effective that are expected to materially affect the company must be disclosed. A small number of you said all standards issued not yet effective needs to be disclosed. And then some of you said, well, we need to disclose everything that is applicable, including those that are not expected to materially affect the company. Now let's understand the relevance of this disclosure requirement. This disclosure requirement was not introduced into IAS 8 so that preparers of the financial statements can spread the word of the work that the IASB is doing, or to be a newsletter to say that these are the new standards that the IASB has published. The role of this, or the purpose of this disclosure requirement, is to deal with changes in accounting policies that are likely to be different or that are going to have an impact on the company going forward. We have established that there's a requirement from IAS 1 to disclose accounting policies that have been applied to the company. So if a new standard has been published that is now going to change that accounting policy, in our view, that is where a company then needs to provide information about that change, to say that there is this new standard that's going to come, that's going to change what we are currently doing for this particular transaction. And on that basis, then that would require additional disclosure to the users of the financial statements. It does not require you to go through a list. I mean, we maintain a list of the current list of what's issued not yet effective on our website, and you can all visit it at some point if you'd like to get a list of that. But the idea is that this is not intended for a company to now go and say, this is everything that the board has done, and this doesn't apply to us, this doesn't apply to us, this doesn't apply to us, this doesn't apply to us. That doesn't serve any purpose, because you wouldn't be disclosing accounting policies for things that don't apply to you anyway. So why must you disclose changes to accounting policies that don't apply to you anyway? And likewise, in terms of whether or not you need to disclose anything if it doesn't have a material impact on you, well, my view on that is that why would you, if you weren't disclosing the accounting policy in the first place, why would you need to disclose the fact that the change to the accounting policy is not going to have a material impact? So really, the question is, well, in essence, the summary of that is that one should disclose the accounting policies, or rather the changes to the accounting policies that are likely to have a material impact, and perhaps a statement to the effect that none of the other changes that are issued not yet effective are going to be applicable, or perhaps are going to have a material impact, would suffice, without necessarily having to list every single one of them, as I've seen some companies doing. It adds no value, it increases the length of the financial statements, and it serves no real purpose in terms of, certainly not from what the standard setters wanted in terms of this disclosure requirement, and doesn't provide better communication. Let's turn our attention back to IAS 1, because this is primarily an IAS 1 discussion, but we had to just jump back into IAS 8 to understand the development of accounting policies and the like, and the selection of accounting policies when we're talking about the disclosure of accounting policies. In February of 2021, the IASB amended IAS 1 and the materiality practice statement that we discussed earlier to explain that it's now no longer a case of disclosing significant accounting policies, but rather disclosing material accounting policies. And this is why I made the point earlier around the importance of that distinction, is that the terms are not synonymous. A material accounting policy is significant, but not all significant accounting policies are necessarily material. Material, as we've explained it earlier, is defined, as we said, a omission, a misstatement, obscuring, the decision making of the primary users of the general purpose financial statement. So nothing changes in respect of that. But what the effect of this is saying is that the preparers of the financial statements must disclose material accounting policies that could reasonably be expected to affect the decisions taken by the users of those financial statements. And the amendments to the practice statement provide guidance on how to apply the concept of materiality to accounting policy disclosures. So what this basically does is it hopefully will result in fewer accounting policies being presented, but perhaps more quality information around the material accounting policies being provided that is more entity specific, more relevant to the decision making of the users, and more useful at the end of the day. The amendments basically clarify that accounting policy information may be material because of its nature, even if the related amounts are immaterial. It clarifies that accounting policy information is material if the users of the entity's financial statements would need it to understand other material information in the financial statements. And they further clarify that if an entity discloses immaterial accounting policy information, such information should not obscure the material accounting policy information. So what does this mean? What is the, pardon the term, significance of this change? Is that we acknowledge the fact that there's no definition of significant. The concept of whether something is significant becomes very difficult to justify and to agree on. You know, one person's view on something that's not defined is different to somebody else's view that's on something that's not defined. But we should find it easier to determine whether something's material, given that there's a definition as well as a whole practice statement explaining this concept. And in light of that fact, one would then look to certain aspects, and this comes out of the practice statement, explaining that although a transaction to which the accounting policy information may be material, it doesn't necessarily mean that the corresponding accounting policy information is material to the entity's financial statements. I'll give you an example of that. Let's consider inventory. Okay, inventory is a good example because IS2, the standard on inventory, isn't a complicated standard. It's a relatively straightforward standard. There may be some areas where there's a bit more judgment involved around measurement of net realizable value and the like, but there's not much to it. It basically says you capitalize all directly attributable costs related to inventory items and you expense them when the items are sold or written down to net realizable value or written off, as the case might be. So while the inventory balance may be a material balance in the financial statements, one doesn't necessarily need to provide an accounting policy explanation of how inventory is accounted for, given that inventory is relatively straightforward and most users of financial statements with a fair understanding of financial reporting would have an idea of how inventory is accounted for. You could probably limit it to 1 or 2 sentences and leave it at that. Whereas in the past, there was this perception that the bigger the number on the face of the balance sheet or the income statement, the more paragraphs you needed in the accounting policy to explain it. One might even conclude that you can leave out an accounting policy for inventory if you don't believe that it's necessary to explain how the financial statements have been prepared. As an example, I'm not suggesting that now we must exclude it, but perhaps one can relegate it to a less significant accounting policy and maybe move that to an appendix of the, to the earlier point where one said that if you do disclose immaterial accounting policies, try to avoid obscuring material accounting policy information. That one way of dealing with that might be to have an appendix or a supplement of the immaterial accounting policies if you feel that that adds any value. But don't have that front and center in the financial statements and you know, clutter up the financial state, the important stuff, with aspects that are considered to be unimportant. Other aspects that the amendments highlight is that other disclosures required by the standards may be material despite the corresponding accounting policy information being immaterial. So the fact that you may conclude that the accounting policy is immaterial doesn't mean now that you can conclude that the disclosure requirements of that standard are immaterial. So judgment needs to be applied in both places. And it does explicitly acknowledge that disclosure of immaterial accounting policy information may be acceptable, although it is not required, but it needs to ensure that it does not obscure the material information. Examples of instances where an entity would likely conclude that an accounting policy could be material in a given situation would be where perhaps there's been a change of an accounting policy. So the accounting policy itself is not material, but the fact that there's been a change, that makes it material perhaps for that year. And then next year, when it's no longer a change and we're working under the new accounting policy, you may conclude that the disclosure in the accounting policy is no longer considered to be material. Or where there's a choice of accounting policy permitted by IFRS standards, and therefore it's necessary to tell the users what your choice was, that might warrant disclosure of what your accounting policy is. Another area is where you've developed an accounting policy in accordance with IAS 8, as I explained a moment ago, where you've gone through the implementation hierarchy to determine how to account for a particular transaction, meaning you need to explain your thought process and the conclusions you got to in arriving at that accounting policy. Where the application of an accounting policy requires significant judgments or assumptions, or where it's difficult to understand material transactions, other events or conditions because they require complex accounting, for example, where more than one IFRS is applied to a particular transaction, event or condition. So these examples out of the practice statement are useful examples to try and identify which accounting policies possibly require more explanation and therefore require additional disclosure. Another thing is to avoid the inclusion of standard generic boilerplate information. Again, very often the accounting policies that we see, certainly in the templates that are used as is that they are copied and pasted or summaries of the standards. And it's generally more useful to provide information that reflects the entity's own circumstances rather than just repeating what the applicable IFRS generally requires. And further explaining giving examples where generic or standardized information may be considered material accounting policy information where it's necessary for the users to understand other material information, or where the entity reports in a jurisdiction where entities also report under local accounting standards, or where the complex accounting is required by IFRS and the standardized information is needed to understand that accounting. So it's not saying that boilerplate or generic information is prohibited, but it's explaining under what circumstances it may be justified. Otherwise, try to avoid using generic or boilerplate disclosures. The expectation of this amendment is that the amendments will impact the accounting policy disclosures of entities, and hopefully we will end up with less lengthy accounting policy disclosure, more useful information. It will require more judgment. And as I said earlier, wherever a judgment is applied and needs to be justified to anybody, it's useful. My recommendation would be to explain the thought process so that you don't have to second guess the judgment later on if the judgment is challenged. Entities should consider boilerplate accounting policies and whether or not they need to be disclosed. And we expect to see more tailored or entity-specific accounting policies going forward. The amendments to IAS 1 relating to disclosure of accounting policies are effective for years beginning on or after 1st of January 2023. And early application is permitted, but once you apply the amendments to IAS 1, you can also apply the amendments to the practice statement. The practice statement doesn't have an effective date because it's non-authoritative. But given that the amendments to the practice statement relate specifically to these changes, those aspects would probably be most relevant once you've adopted these changes. The reality is I don't see anything precluding a company from adopting already, because it doesn't change the numbers, it doesn't change the financial position or the profit or loss for the year. All it does is it simplifies the preparation of the financial statements to an extent by removing the unnecessary bits, but perhaps complicates it a little bit more because there's more judgment required around what is retained within the disclosures. So I think once companies have managed to wrap their heads around that, I don't see any reason to delay implementation. There's no retrospective application or any corrections to prior periods. It's just a case of adjusting the approach to accounting policy disclosures going forward. Lastly, then, before we move on to the case studies, we have another requirement from IAS 1 to disclose judgments that management has made in applying the accounting policies that have the most significant effect on the amounts recognized in the financial statements, as well as the assumptions made about the future and other major sources of estimation uncertainty that have a significant risk of resulting in material adjustments to the amounts in the financial statements within the next year. And these disclosures, you often find companies grouping them together into a single place, judgments and estimates, or significant judgments and estimates. Firstly, nothing says that they need to be presented in a separate part of the notes or in a separate place to the accounting policies. But often when I look at financial statements, when I'm reviewing financial statements for IFRS compliance, I find that what companies disclose to address this disclosure requirement is they just extend in the accounting policy to explain that the accounting policy requires judgment. It doesn't provide the disclosure of the judgment. Or as an example, I'll give a simple example. Concluding that a company controls another company with less than 50% of the voting rights, which is possible, of course, under IFRS 10, the standard on consolidated financial statements. Now, getting to that outcome requires judgment. And IFRS 10 acknowledges that judgment. The disclosure shouldn't be to say that management applies judgment to determine whether or not to consolidate the other entity, because we know that that's what IFRS 10 requires, and you haven't really added any value to the disclosure in the financial statements, but rather explaining the specific circumstances in that scenario that led management to conclude that it had control of the entity. That's what needs to be disclosed. And that can't come from a template or from boilerplate or generic wording that you can copy from another company. That's explaining what happened in that scenario. So what were the reasons that led you to conclude that you have control of that company? That's what needs to be disclosed in disclosing the judgments. The proposed disclosure should consider the alternatives that management considered, explaining why the choice was difficult or judgmental, and a fact-specific, entity-specific explanation as to why option A was chosen over option B. Option A was we have control, option B was we don't have control. What led you to the conclusion that you got to in the application of the judgment? Similarly, with respect to sources of estimation uncertainty, yes, everything that's an estimate is subject to estimation uncertainty. So when one discloses the sources of estimation uncertainty and the assumptions made around that, it's important to disclose the inputs, the variables, the aspects that are subject to the uncertainty, prioritizing quantifiable disclosures over qualitative information, and explaining the sensitivity of the outcome to changes where relevant. There's no specific requirement. Well, there is a requirement in the sense that one needs to explain sources of estimation uncertainty that are subject or could result in material mistake or material changes rather in the coming 12 months. But again, this is very entity specific. So if the discount rate for a particular liability that is used to present value a liability was subject to uncertainty around the estimate that was used, around the risk-free rate or the risk premiums that were added, explaining what judgments were made around those inputs, as well as any sensitivities to those inputs if a reasonably expected change in the outcome could materially impact the measurement of the liability in question. Just some examples of the disclosure that might be relevant. This was just an extract from a set of financial statements. This talks about the disclosure of talking about a particular issue around the judgments on the measurement of deposits and payables, and talking about the challenges that led to the measurement of the amounts reflected in the quantitative disclosures down below. In a follow-up to that, in the disclosure of the accounting policies, they explain the areas where the application of the policy requires judgment and the types of the factors that they take into consideration in determining the outcome of that measurement. One last point then is that the notes and the structuring and the layout of the notes has no particular order. There's this perception that's existed in financial reporting over the years that there's this formal order that has to be applied. It may be a convention, it may be a practice that's evolved over the years, but the standards themselves don't specify how the notes should be presented. What the ISB has done is they've clarified that the notes should be arranged taking into account the understandability and comparability of the financial statements. The standard setters have given some examples that one could follow, but it's not to say that these are now mandatory or required in order to achieve that outcome. So some examples would be giving prominence to areas that the entity considers to be most relevant, grouping items together based on similarity, or perhaps following the items, the order of items in the primary statements, but not necessarily letting that be the be-all and end-all of the of the ordering of the financial statements. I think very often, certainly when one looks at the traditional layouts, that we kind of emphasize that without considering some of the other elements that the standard setters highlight could be useful. So I'm going to pause for a moment and see. I see there's been one question that's come in. Just want to read the question. You've mentioned that an application materiality judgment definition is a judgment area for auditors and management, and they have to find common grounds. If in case that this will remain an issue for both parties, do you think a standard should be made to help address this problem, or is it better to leave it as a matter of their judgments? I don't believe, okay, so the question is, do we believe, do I think that there will ever be a standard that directly addresses the debates or the challenges between auditors and auditees around the application of judgment? I don't see that that will ever come from the IASB. Remember, from an IFRS perspective, there's no requirement for financial statements to be audited. So from an IFRS perspective, the standard setters don't comment on how to deal with the fact that the auditor might have a different answer to you or a different view to you. If anything like that ever has to come out, I think that would have to come out from the auditing standards. But I believe that the auditing standards have that, where one would need to have a process in place to deal with identified misstatements or areas of disagreements and things like that. Yes, it's always going to be open to judgment. And I don't think that either the IFRS standard setters or the ISA standard setters want to become prescriptive to say this is how it shall always be done. I don't see that it'll ever come out to a case of saying, well, in the event of a deadlock, the auditor will always have the final say, because I don't think that's the right answer. I think the parties need to have their say and see whose answer is more supportable than the other, and whether one can find common ground or agree to disagree, and whether that's something that one could then indicate as an area of judgment with an emphasis where necessary. But yeah, that's the best answer I can give to that question, Earl. Just want to see if there's any other questions that have come in there. Okay, no, nothing else from that side. All right, then I guess for the remainder of the session, we've got just under 30 minutes left, but that gives us sufficient time to go through a couple of these case studies. The case studies were published by the IASB as part of this ongoing project, as an additional source of guidance. And what the board did was they published a discussion paper a couple of years ago talking about principles of effective communication. It dovetails into the problem statement that I mentioned earlier: not enough relevant information, too much irrelevant information, and ineffective communication. That's at the heart of the disclosure initiative. And in the discussion paper, the board explained that, in their view, principles of effective communication involve the following elements, the following characteristics. Generally speaking, they would say that effective financial statements are entity-specific. They've been tailored to a company's own circumstances. They are simple and direct. They use simple descriptions and sentence structures without omitting useful information. They are better organized. They rank information to help users of financial statements understand the importance of the information. They are better linked, to my earlier comment around cross-referencing. Linking information helps users understand the relationships between pieces of information. They're formatted clearly and better, just in terms of how they're laid out and viewed. Free of duplication that potentially results in clutter and obscuring of communication, and enhanced comparability by disclosing information that enhances comparability among companies and across reporting periods without compromising its usefulness. Now, in other words, be comparable where it is good to be comparable, but don't just follow the herd and do things the same way everybody else does it, if there's a better way of doing it that achieves all of these other objectives. So these were the principles of effective communication that the board identified as being at the heart of a good set of financial statements. And then some companies around the world took on the challenge and agreed to undertake an exercise to restructure, reformat, revamp their financial statements while looking to these principles as a basis for doing so, for the changes they were going to make. The first case study comes to us from a company called Fonterra Cooperative Limited, Some of you may know them, but or may not know, I don't know. Fonterra Cooperative Group is New Zealand multinational dairy cooperative. It's responsible for approximately 30% of the world's dairy exports. Its revenues exceed 17.2 billion New Zealand dollars, and it's New Zealand's largest company. They were one of the companies that reported back on their experiences. And in the case study, in the feedback that they provided, they explained the process involved support from senior management. They created an internal review team consisting of staff members from both the accounting and the investor relations teams. They workshopped the exercise with the company's auditors to identify the information needs of different stakeholders and to communicate the information in a way that would ensure that stakeholders could easily understand Fonterra's story. So already at the outset, just in this opening explanation, one can see that this isn't something that was done in the month or 2 months between year end and reporting date. You've got reporting date at year end, but what I'm saying is publication of the financial statements. This is an exercise that required a project, a bigger project that wasn't just limited to the finance team or the CFO. It involved bringing in different skill sets, different parts of the business, and also involving the auditors so that there couldn't be this argument at the end where the auditors say, we don't think that you've done the right thing over here, and it was all for nothing. The key themes was one of the things that Fonterra reported as being central to their changes that they made. They determined that key themes was the best way to package and reorder the information in the financial statements, and grouping of related notes across these key themes, these relevant themes. So as an example, when one looks at their financial statements prior to the change, and I'm sure this is similar to many that you may have seen, it's simply an index page of all the various notes. If one just goes through the list, we've got the cost of goods sold, profit loss. So we've got all the income statement things first, then we've got segment reporting, and then we have balance sheet items down below. And then somewhere down the line, we've got other information that's presented that doesn't kind of fit into that balance sheet or income statement. All they did was they just said, right, what are the key themes around that? And groups the same notes into performance, debt and equity, working capital, long-term assets, investments, financial, and other. Simple change, but an effective change. Because a user of the financial statements opens that index page and says, right, I want to understand the profitability, the performance. So the focus is on the notes relating to that, the information relating to that. Information around investments, you can go straight to the notes relating to that, whether it's income statement or balance sheet, it's all in one place. It's got all the relevant information in that place. So that was a simple but effective change that achieved 3 of the principles of effective communication. The other things that they did was that they report back on as having done was they reduced the detail in the notes by highlighting the relevant matters and identifying what was material, what's important to the users, and deleting the general clutter, the general information that was considered to be clutter. So again, as an example, looking at a note before the change, which could have been any one of our financial statements, a lot of generic wording, a lot of boilerplate wording over there around the basis of consolidation, simplified it with more direct, more clearer language, explaining only the parts of the issue of consolidation that's relevant. And yeah, I mean, we understand the standard explains what control is and all of that. It's only a real issue if you need to go into detail around the application of the judgment. So it's far easier to just say we consolidate when we obtain control, and we stop consolidating when we lose control. You don't need to go into the discussion around what control means and the definition of control and all of that in the disclosure of the accounting policy in this example. They relocated accounting policies, judgments, and estimates to the note and used less formal and technical descriptions in their disclosures. Now, these are some changes that you may have seen some companies doing already. Again, these are short, easy to achieve changes that shouldn't really involve too much conflict or controversy, but also make it a lot easier for the users to work through. So, for example, where you had the disclosure of the cost of goods sold as a standalone note here, and perhaps the accounting policy on cost of goods sold earlier on in the notes in the accounting policy section, and the judgments around that somewhere else. They just bring it all together so that the user that's looking for information around cost of goods sold can go straight to that point and get all the relevant information in one place. Simple but effective change that makes the reading and the understanding of the financial statements that much easier. They merged notes where these were interrelated. That was another change that they felt would also achieve some improvement around the communication of the message. So historically, they presented three very distinct notes: contingent liabilities, provisions, and commitments. As you can see from the numbering of these, there were obviously other notes in between these. And yet when one takes a step back and says, but a contingent liability, granted, contingent liabilities, provisions, and commitments are different things, but they all are potential claims on a company's resources. So from that perspective, would it not make sense to deal with them together, acknowledging the difference between them, that, you know, contingent liabilities are not recognized, provisions are recognized, and commitments, well, they disclose, but bringing them all together into one place that really talks about contingencies, provisions, and commitments. So a user doesn't have to jump from one section to another and try and figure out what are all the potential claims on a company's resources. The last one I'd like to talk about is sorry, I know there's one more coming from Fonterra, the reformatting of the content to be more investor friendly. This is more of a stylistic approach. And again, you might have different views around how this works and how one, you know, achieves this. And it's not to say now that everybody has to follow this, but they felt that it provided a more impactful piece of information to the users by re-looking at how they had traditionally presented certain disclosures. The example that they've given us here is dividends paid. So this is a factual disclosure. It simply says that on certain dates, these are the dividends, the certain amount of cents per share, on what date, and all of that. And it kind of went on and on. I mean, this was just an extract, but it kind of just was not that nice to read. It wasn't a very nice note to read. And a simple change that they then brought in was to try and repurpose or repackage the information in a way that is more impactful and easier for a user to get a sense as to what's happening. So they took what was common to all dividend payments as the introduction to this table, explaining that these were the dividends, or, you know, these are the terms around the dividend declarations during the year, and then just listing the amounts per dividend declaration and the dates, just to make it easier to read. Now, what I wanted to highlight through these examples that I've included over here is that none of these are objectives in and of themselves. You shouldn't be looking at this and saying, we need to get to the same answer over here because Fonterra did. But it's showing the approach that Fonterra took and how they looked at the key principles, because every one of the changes linked back to one of the key principles that we spoke about earlier. So by looking at these key principles and seeing, can we achieve some of these principles by changing how we do it? And if the answer is no, the way we've got it is the best way, that's fine. Then that doesn't mean you've got it wrong. It just means that you are currently doing the best thing for your particular circumstances. But the aim of these case studies is to give you some examples which are acceptable within IFRS standards, because the IFRS standards do not dictate or specify how you need to package the information. They simply say you need to communicate the information effectively. Some of the key lessons that came out of the Fonterra case study, the users agreed that the financial statements became easier to read. They acknowledged that the main challenge was to decide what to tackle first. And I think coming off this feedback, I would say that this is not a one-year exercise. I don't think this is something that you can say, we're going to start it now in 2021 and we're going to finish it by the next reporting date. You might find that you do incremental changes or you know, bring some of these things in incrementally over an extended period of time and prioritize what you believe is most important, or maybe prioritize the quick fixes and then deal with the more complex areas as a secondary element. It just depends on what changes you think would need to be made. Another challenge was deciding who should be involved. We mentioned that there were different stakeholders in the exercise that were consulted. And they said that it was very important to get senior management buy-in in this exercise and involve external and internal stakeholders as well as the auditors. They accept there's no single correct way to present something, and it's not something that they would say that they have now reached the end of the process. They might find that there's still changes to be made, but agree a timeline. Don't wait until after year end. That's usually where we start rolling forward the templates and start populating the current year information, because you'll never get it done. You'll always be kicking that can further and further down the road, because there'll never be enough time to do it all in that limited space available. Except that this is a long-term project and you might need to bring some of these changes in bit by bit. But the key thing here, the key factors that they say were the most successful were the involvement of senior management, engaging with the investors to identify the information needs, bringing in the relevant departments involved in the reporting process, and making sure that, that everybody was willing to discuss the proposed changes. Moving across to the next case study, this was the ITV case study. ITV is a British media company. I think it's the second largest, well, after the BBC, but it's the largest independent or commercial terrestrial TV station in the United Kingdom. Turnovers of £3.2 billion. They also were part of this case study. They decided that they were going to take on the project. Similar to Fonterra, they also included a multidisciplinary team involving accounting, investor relations, tax, treasury, pensions, mergers and acquisitions, and group secretarial departments. And all of the changes in disclosures were reviewed by the relevant teams and approved by the audit committee. So again, an ongoing project that wasn't all done in one go, but involving different stakeholders. In terms of the key themes, they grouped their notes into basis of preparation, results for the year, operating assets and liabilities, similar to what Fonterra did. So creating a bit of structure, highlighting the wider relationships among the information provided in the notes. So once again, looking at the index page that simply just had, going in order of primary statements, notes, and so on and so forth. They structured the notes around groupings or sub-notes. Section 3 dealt with operating assets and liabilities, Section 4 capital structure and financing costs, and so on, and trying to find the common elements across these sub-notes that resulted in that grouping. Each section of the notes in the ITV financial statements was then introduced by a brief paragraph about the nature of the transactions and the balances dealt with in that section. They call it signposting, and the signpost was with the label "in this section." And then in that same paragraph, they provided a further description of the nature of the transactions and the relevant accounting in a clear, simplified manner. So as an example of that, what they did was, at the introduction of each section, they said, right, this is what this section is all about, this section on operating assets and liabilities. Each one of the subsections talks about what that deals with and why it's important to the user. So this isn't really accounting policy, but it's explaining what the information is about. That's more useful, I think, than copying and pasting paragraphs from the standards in an effort to try and explain to the users how IFRS works. That's not what this is trying to achieve. This is trying to explain what that information is communicating, why it's important to decision making, and what users of the financial statements can take out of that. So it's just a synopsis or a brief extract of what's to come. But it helps for a user, so a user could read that, say, right, okay, that makes sense to me, I'm happy, and move on to the parts that are more important, or decide to delve in deeper and get stuck into the note disclosures relating to working capital in the example that's on the slide here. They relocated the accounting policies, judgments, and estimates to the relevant note. That's a common theme. Everybody's been doing that, and I think it's such a wonderful thing, because prior to that, you had to have one finger on the accounting policies, one finger on the judgments and estimates section, one finger on the note, on the balance sheet part, one finger on the income statement part, and one finger on the risk disclosures to try and understand financial instruments, for example. Now everything's brought together into one place. You can see the accounting policies, the judgments, sources of estimation uncertainty, and all of the disclosure requirements in one place. So that was the other change that was made there. In addition to that, though, sorry, I jumped ahead there. In addition to that, the standards, not the standard setters, ITV included more detail around the terms and conditions around the transactions relating to a particular disclosure note under the subheading key terms. So what they did there was, for example, with an acquisition and disposal of a business, that it was just a paragraph explaining that the business was acquired and so on and so forth. Whereas they broke it out to explain that these were the key terms of the transaction, and this is how they accounted for the transaction, just to explain the application of the accounting standard to that particular transaction better. Another useful outcome was the inclusion of question and answer narratives in the notes. They felt that for users that perhaps aren't very clued up on financial reporting, this was useful to explain what are the pension schemes, what is a defined contribution scheme, by explaining it from that perspective rather than quoting technical guidance out of the standards. So this was perhaps a simplified version of an accounting policy, or at least to help clarify the application of an accounting policy by explaining these concepts. Very often I see companies just copy and paste definitions from the standards. That's fine for the professional accountants, but the users get overwhelmed with definitions. This just explains in simple language what this is all about. The lessons learned from the ITV example was that the multidisciplinary team was successful. Planning well in advance of year end was critical, and they collaborated consistently with their auditors through this exercise. We're going to do two more case studies before we wrap up. The orange case study relates to the French multinational telecommunications corporation. 256 million customers worldwide, employs 95,000 people in France and 59,000 elsewhere in the globe, with turnovers of 41 billion euro. So these companies are giants, without a doubt, but that doesn't mean now that only the giants should be doing this. We can learn from the experiences that the giants have shared with us. In the case of Orange, they actually took it one step further and asked their investors what they wanted, what changes they wanted from their financial statements. Don't know why nobody ever thought of that before, but we've always assumed that we now need to understand what the users need. Why don't we ask the users what they need? Why don't we say to the users, guys, you've been identified as a primary user. How would you like us to package the information? Remember, we're not talking about now management information or anything like that. We're saying for the general purpose information that we're presenting to you, do you care about certain aspects of the financial statements, or would you like to see it packaged a certain way? So by polling their users, they were able to understand whether they were providing adequate information for their investors, whether there were any structural changes needed, and basically collecting suggestions for improvements. Their exercise resulted in them stopping the disclosure of performance measures that investors said were not useful. And they focused on information that mattered most to their investors by providing more detail in the notes or removing information that was considered unhelpful or creating clutter. Some examples of the outcome of that, on the note that they had provided previously around sensitivity of recoverable amounts, they restructured that note to similar to one of the earlier examples, I think, for Fonterra, where just by structuring the notes slightly differently and providing the information in a tabular format, that immediately made it easier to read and understand what was happening over here. Same type of information, but just providing more visually easier to understand information. They relocated the description of the accounting policy in the same note, again, a common theme, and redrafted accounting policy descriptions to highlight judgments and estimates used when applying those accounting policies. Again, recognizing that the separation between the accounting policy and the application of the accounting policy was something which should never have happened in the past. Somewhere along the line it happened and everybody just followed suit. But now explaining that this is our accounting policy, these are the areas of judgment relating to that, and this is the information that came out of that all in one place. Demonstrating exactly the same information, but having more useful information around the judgments around onerous contracts, the treatment of certain of the expenses. So mixing up the accounting policies and the judgments, but highlighting everything that's relevant to understanding external purchases. They also try to improve the clarity of some data-intensive disclosures that investors had struggled to understand in the past. Again, coming out of the feedback from the provided by the investors. Around dividends, this was another example. It seems like dividends was something that most companies were getting wrong in the past, or at least we could have improved on. Similar to one of the earlier examples was just to try and bring out the important aspects of all of these individual transactions throughout the year, again, making it more visually understandable than what may have been the case in the past. Orange reported a couple of challenges that they had was around maintaining the comparability of the information over years of changes. And this, I think, is quite an important point to highlight here, is that we can't wave a wand and suddenly change everything from what it looked like before. The users are going to find that worse because they're not going to be able to understand what to make of it. They're not going to be able to understand how to deal with it. So you might want to introduce some of this change incrementally, bit by bit, and allow users an opportunity to familiarize themselves with it, or highlighting the processes and the changes that have been made in the financial statements when those changes are made, by explaining, we used to present this information like this, we're now presenting it like this, and guiding the users through the process as you proceed through it. The last case study before we wrap up the discussion is Pandora. I'm sure the ladies that are listening will recognize the name, and the gentlemen will probably have recognized the items on their credit card statements, the names on their credit card statements. Pandora is a jewelry company, the third largest jewelry company in the world in terms of sales, based in Denmark, and their turnover is 23 billion Danish kroner. Pandora's report back on their exercise to improve their reporting, they also followed a continuous basis as part of the internal process. So it wasn't. So after each annual report was published, they then did a review. They involved stakeholders, and they used the feedback from that to feed into the next year's round of financial reporting. I think this is another important message: is that rather than just simply rolling forward the template, let's roll forward the template, but make the necessary changes based on feedback that we're getting from our stakeholders. This was then reviewed by senior managers and the audit committee. They also grouped their notes into sections, and the sections were aligned to the information in other parts of the annual report. So here there was actually a linkage to the management commentary, which I found quite interesting, with a cross-reference. So you've got, before you had the various notes, but then you had the notes aligned to the grouping of the information in the chairman's report, in the management commentary review, and grouping it along those lines. So again, being able to, for a user to be able to compare the management commentary to the financial statement information. In each section, they then also set out key performance measures, significant transactions, and balances for that section. Now, that's not part of the IFRS requirements, and nothing prevents you from doing that if it's not creating clutter or obscuring the material information. So here they highlighted, they provided a commentary on the items in there, which may have been included in the management commentary separately before. So kind of aligning the two, but this was seen as being extra, and then within that section, they then had all of the financial statement disclosures relating to the commentary that they're talking about here. The company acknowledged that in the notes, some financial ratios may be calculated differently, and in order to explain to the users how the ratios are related to this company, they then explained what the ratios are, which I think is also quite useful. Very often you just see the ratios thrown in their percentages without actually explaining what those ratios are or how they've been calculated. And then in terms of reformatting the notes, they redrafted a narrative around the financial risk arising from fluctuations in commodity prices, and used that as a basis to explain graphically how that impacted their business. So Pandora incorporated a lot more elements of management commentary in appropriate places, distinguishing what's commentary versus what's disclosure, but linking it so that the users could better understand how this information was relevant to them, and nothing prevents a company from doing that. Lastly, just introducing some symbols to signpost descriptions to differentiate what's an accounting policy, what's a judgment. They felt that would be useful. So for example, accounting policies were disclosed with a particular symbol, and significant accounting estimates were disclosed with a different symbol to draw attention to the fact that, you know, to the users to understand the implications of those. The lessons learned from Pandora was that it actually, and this goes back to one of the earlier comments, it hasn't saved time. It's probably extended the process of preparing the financial statements, but that doesn't mean now that that's why we don't do it. We do it because we believe we're adding value to the users, and we're preparing financial statements for the users. Therefore, that is the objective of the financial statements. So anything that creates value for that is, in my view, worthy of the effort. But that's why one shouldn't leave it till the last minute, given that it is going to extend time and require more resources for that. And one last lesson that Pandora reported on was the fact that it's not a once-off process. You don't do this once and then you say, right, we've fixed our financial statements and we're done. End all the short-term contracts for everybody we brought in for that. The exercise is a dynamic, ongoing process, and it's something that you're going to need to continuously adjust and tweak and respond to. Be careful not to overwhelm the investors with too much change, and be sensitive and attentive to investors' informational needs in order to achieve success. Those are the 5 case studies of the global giants that participated in the exercise and who have shared their experiences from improving the communication with or rather to their investors. Over the course of the last 3 hours, we've covered quite a bit of information regarding the general features of financial statements. We've spoken about the concept of materiality and the changes and developments around the materiality practice statement, the amendment to the definition of materiality, and the changes around disclosure requirements insofar as they relate to material items. The most recent amendment to IS1 being the disclosure of accounting policies, and finishing off with the examples of better communication. For the last couple of minutes, I see we've just gone over the hour. I just want to have a quick look at the questions that have come in. I see a question from Francisco Perel. Can we capitalize pandemic as a reason that the company will not operate in a going concern? If I understand the question, I don't think we're saying that the pandemic means you're not a going concern. It just means that to the extent that you are affected by the pandemic economically, the question then is, what does that mean to your ability to continue as a going concern? So what that basically means is that if you are, for example, if you're in the airline industry, and many airlines have struggled and some airlines have closed down because of the restrictions on global travel. So under those circumstances, if you believe that there are mitigating factors that, notwithstanding the challenges, the short-term challenges, you are able to continue to obtain funding, you believe that the relaxations will reopen your prospects and allow you to continue, then it doesn't mean you're not a going concern, but it's something that needs to be addressed in your disclosures. And I think that's my message, is to say, don't ignore it, but it doesn't mean you are or you're not a going concern. You just need to attend to it in your disclosures. The next question is, in relation to changes to these, could we expect to see similar changes to items relating to the ISAs and audit reports, particularly the director's report and auditor's report, in better simplifying the message that they are looking to get across to the users of the financial statements? I am a former auditor. I'm not a current auditor, so I'm not as close to the developments in the auditing standards, but my understanding is that yes, there have been some changes made already in terms of the audit report, the disclosure of key audit matters and those types of issues, which I think also were to a large extent similar to these initiatives over here, is trying to provide more useful information to users of the audit report. So already with the reformatted audit report, I think that's come a long way from what we had before. I'm not sure what ongoing projects there are in the ISA space, But yes, I would imagine that this is also something that's happening there. Pesh asked the question, you have mentioned the contingencies to be disclosed. My question relating to unestimatable liabilities, do we also need to disclose a liability that will become our obligation only if an event in the future is realized? For example, a future revenue generated which cannot be easily quantitatively estimated on balance sheet or just as a note. I think this goes a little bit beyond the scope of what we're discussing here. I gave the example of contingencies as part of grouping the notes together, but to the extent that there's a contingent liability, IS 37 explains the disclosure requirements to say that if you have an obligation, a present obligation, but you cannot reliably measure it, and hence I'd imagine that's what's unestimatable, then it is disclosed as a contingency with whatever information is available in the disclosure. So you wouldn't recognize a liability that you cannot quantify reliably, but that would still require disclosure in the financial statements. And then the last question that's come up is, what is a company suspended half year? Is that fall to going concern basic or not? If the company is reporting at half year, then in the interim financial statements, the assessment of going concern would need to take that into consideration. If the company was suspended and then is no longer suspended again, and by the time the annual reporting period comes along, and there's no other going concern challenges, then that would probably not require, but I would probably still want to see some mention of that, because a user of the interim reports would probably also be a user of the annual reports, and there would need to be some kind of acknowledgement of what's happened in the disclosure. But I think that's what I can make out of the question. I'm not sure if I fully understood the question there, but disclosure around your judgments around going concern have to be disclosed. I think that was the key message coming out of our discussion thus far. I think those are all the questions that came up, if I'm not mistaken. I think, yeah, I don't know if Casey, if I can hand back to you. Just sure. Like to thank CAMED Business School for inviting us to speak here. I'm not sure if anybody from that side wants to finish off with any concluding comments.
I would like to thank you very much, Blaise, for your time today and your preparation and your very clear explanation. As president of CAMED Business School, my mission is to work to contribute to economic growth. And economic growth and investment is facilitated with financial reporting, financial information that is useful to supporting economic decisions. And the theme today and your presentation today, Mr. Colivas, will help us and help our participants to improve the relevance of their financial reporting to support economic decisions and make a contribution to economic growth. Today, you covered some very fundamental concepts, and it's important to cover and be clear about these fundamental concepts. When you have a strong foundation, then you're going to have a very well-constructed house or structure. And I appreciate covering the change in the definition of materiality and the requirement or the change from significant disclosure of significant accounting policies to material accounting policies with the examples that you've provided. And I appreciate that you have covered the case studies with us. My favorite is the disclosure note of ITV, where the policy and the judgments and the figures are disclosed in a single note. Thank you very much for those practical examples. And I hope that we can have an opportunity again for you to present to our audience. Thank you, Blaise. I am now going to post, I have now posted into the chat, I've posted a form. And I'll post it a few times. I posted a link to a form, which is the evaluation form, to get feedback from all of our participants We are asking you to evaluate our workshop today. And there's a very important question. We ask you to give us your recommendation for a topic for our next CPD workshop. For the CPD certificates, they will be prepared and sent to you, to all the participants via email tomorrow. Thank you very much. And it's wonderful to have guests today from around the region. Today we have some guests from the Philippines, from Singapore, from Malaysia, from Cambodia. And it's an honor, of course, to have Mr. Blaise Colivas with us today from W Consulting in South Africa. This is the power of the new normal, that we can come together and share expertise around the world. Please, everybody, take your time to submit your evaluation and stay safe. I wish you and your families all the best and good health in this time. And as a final thanks to our IT team, especially Mr. No Solin. Thanks to LSC, especially Mr. Chun Naren and Chut Buna for their coordination. And thanks to our translator, Mr. Chinchana. Unfortunately, the translation channel wasn't working properly, but we hope that we can have the translation channels functioning correctly in our next seminar. Thank you, goodbye, good evening, and enjoy the remaining Sunday and weekend that you have. See you soon.